Good morning, everyone. Welcome to Yahoo Finance Live. I'm Brad Smith alongside Madison Mills. Happy Jobs Friday to everyone who celebrates. Of course, you celebrate. You're here with us, rocking with us today here. We got to tee up exactly what we're looking for here on this employment situation Friday here, where we're standing by for the numbers that are going to drop in just a moment here. Comes in a big week of jobs-related data, labor economy data as well, that we've gotten, whether it be in the form of JOLTS, whether it be in the form of the ADP private payrolls. A lot leading up to this moment here, and you're taking a look at futures ahead of this print that we're expecting in just a few minutes at 8:30 a.m. Eastern Time. All major U.S. major averages right now. The futures are pointing lower right now, Maddie.
Yeah, it's been a little bit of a snooze fest when it comes to markets since about 6 o'clock yesterday, as just anticipation builds for this jobs data coming this morning. And it's one of the biggest spreads when it comes to bank anticipation of where this jobs number is going to come in. We know the estimate for us 185, but Deutsche Bank saying 130. Goldman Sachs is saying in the 230 range. So a very wide range when it comes to estimates on the street. And Brad, I think that's indicative of how challenging it is to suss out what the data means in this moment that is kind of a first in so many ways.
Yeah, and when we think about ultimately those estimates that you were mentioning a moment ago, the headline print, we're looking for about 185,000 and the unemployment rate to stay at 3.9% here. Now, ultimately, for the conversations that we've had over the course of this week, I think back to something that Matt Luzetti told us from Deutsche Bank, saying that this is a very critical juncture for the jobs market, for the labor market, and the tightening that we had seen. At this point in time, you're seeing some weakness in that JOLTS print that we got, where people who had the ability to jump jobs and were guaranteed that they would probably get a higher wage, that's starting to trickle just a little bit lower here. So one of the things that we're going to be watching for in this particular employment situation is what sectors continue to see strength. Because if we look back to the ADP number that came out earlier this week, it was services producing sectors that accounted really for all of the gains that we saw there at the end of the day.
And some of the bankers on the street are suggesting that we could be seeing consumer spending move from services to goods. So I wonder if we'll see that in the data. I am still looking for clues in the bond market in particular. If you look at U.S. high yield bond spreads, they've fallen to the lowest level since April of 2022. So you have to wonder whether the market is sort of retracing a little bit of the risk on momentum. And if the labor market does come in strong, we could also absolutely see a flip to the bond market heading into the latter half of our 8:30 hour here, Brad.
Yeah, a lot that we're going to be tracking. Once we get this number that comes across, first and foremost, we're going to be taking a look at yields to see exactly where things move. Again, at the end of the day here for the Fed, it's a matter of, do they continue to see a trend that actually, because this has been a Fed to this point that's been able to lean on the strength of the employment situation and the labor market in order to make sure that they're able to continue combating inflation in a very aggressive manner. Higher for longer is what we've continued to hear. So does anything that we see in this report today lock in a trend for them, as they're going to be continuing to be data dependent in order to say to themselves, all right, now we at least at some point have to start to communicate that maybe we'll put a cut on the table next year? If you heard from and were listening to what Fed Chair Jay Powell was saying last week in some of the Fed speak that we got, or even Mary Daly, there was a lot of cold water that got tossed on some of those expectations for an early in the year rate cut at the end. So that's something that we're going to be continuing to watch, but U.S. major averages in negative territory right now.
Most important jobs report since the last. CPI next week will be the most important since the last as well. So anxiously anticipating this job report as it is starting to come in a couple of seconds here, Brad.
Absolutely. All right. Well, we've struck 8:30 a.m. Eastern time, and the U.S. employment situation numbers just dropping here for the month of November. You're seeing the print come in at 199,000 jobs added. That is the change in non-farm payrolls. The unemployment rate ticked lower. That came in at 3.7%. And then additionally here, taking a look at some of the average hourly earnings month over month, we're still getting some of that starting to trickle in here. The average weekly hours for all employees, that's little changed at 34.4 hours here. And the labor force participation rate coming in at 62.8% here. So again, that headline number higher than anticipated, and the unemployment rate edging lower to 3.7%. Job gains here, it seems, occurred in healthcare and government. Employment also increased in manufacturing. That reflects the return of workers from a strike, the BLS notes here. And then employment in retail trade, interesting there. to see that decline here. So a lot that we're continuing to dig into with this report. I mentioned that labor force participation rate here, and I'm going to be digging lower for a little bit on the chart here. Little change, though, at 62.8%. That's been essentially flat since August. So that's some of the backdrop and context for us to remember with this report, too.
Yeah, Brad, and as you kind of look into that number, I want to do a bit of a markets check here. The S&P 500 futures sliding, Treasury yields are jumping. Of course, the market's going to continue to digest these numbers that are just dropping here. Looking at the Bloomberg Dollar Index rising to a session high after that post-payrolls data, seeing a little bit more of a dip in the Nasdaq, down by about 0.8%, S&P 500 down by almost 0.5% there, and Dow futures down by 0.3%, Brad, as we kind of digest these numbers. I'm really curious to know what the average hourly earnings are looking like year on year and also month over month, because that is something that the Fed is going to be looking at when it comes to how the wages are looking and how strong the consumer can be in this environment.
Asking you shall receive, Maddie. It's a good day for you here. In November, average hourly earnings for all employees on private non-farm payrolls rose by 12 cents, or about 0.4% here. Now, over the last 12 months, that year over year, that average hourly earnings number, that increased by 4% here. So ultimately here, a few of the sectors that we've been continuing to track, which we'll dig into just a little bit more later on. But of those sectors that saw the most job growth, healthcare adding 77,000 jobs. That's above the average monthly gain that we've seen of 54,000 over the prior 12 months. And then additionally, government increasing by 49,000 in this most recent month of November here, in line with the average monthly gain as well here.
We're going to go to our panel here. I'm lucky to be joined by a former Bloomberger with me, Joe, RSM chief economist, and Stephanie Roth, Wolf's research chief economist, to discuss this jobs report. Joe, I want to go to you first. What is the big thing sticking out to you here?
This is what a soft landing looks like. This is what full employment looks like. You should like full employment. I like full employment. We all should like full employment. This is just another and a steady drumbeat of very positive economic news.
If you're Fed Chair Jay Powell, Stephanie, and you're, dusting off your slippers this morning, pouring out your cup of coffee or whatever tea he might like to drink, what's your read on this at the end of the day?
He probably doesn't feel great about it. I hear you, full employment is good, but this isn't exactly the kind of print they were probably hoping for. I mean, especially the household survey, that was pretty hot. You saw over 700,000 gains in employed workers there. Granted, it's a volatile survey, but that took the unemployment rate down 0.2. So,
but does it take us so tremendously off trend that it's going to have the Fed kind of realigning or changing their tenor in these meetings right now?
Not necessarily, but I think the market took the Fed's, kind of ran with this narrative, and I think it's going to have to get reversed to some extent, at least after this print. Granted, the data are really volatile. This is a very seasonal month for payrolls, but it's just not exactly what the Fed was hoping for.
Fixed income market's a bit overbought. The appropriate or fair value should be around 4.5% on the 10-year look. Once you lop off the 35,000 that we saw come back into the market, you got a much better number in terms of a Fed-centric view. They're not going to do anything next week. They're on hold. Now, we think there will be rate cuts, but in the second half of the year, primarily because we've got a maturity wall of debt coming due in 2025 and a huge tax cliff coming on the policy side. Best central banking policy is always forward-looking. I think by the time we get to the second half of next year, the Fed will be well-positioned to cut rates because we're going to be headed towards 2.5% on core and top-line inflation by the end of next year.
But if it's forward-looking, how do you continue to have the soft landing narrative when average hourly earnings are still a beat? We're seeing the market reacting to that. How do we get to 2% inflation with this strong of a labor market?
Because we can look at the Cleveland Fed's new tenant rent index, and we can see the dragging down of top-line inflation that's in front of us because of the easing in rents. Moreover, when you take a look at the trend in underlying wage growth, we're moving towards 3.5, which is what the Fed wants to see and what's stable. Look, one era ended. The era of zero interest rates is over. All of that data is very nice to talk about, but it's in the rearview mirror. And I think going forward, 3 to 3.5% on wages is what we should expect. Look, the economy is going to continue to expand. We think there's a 25% probability of a recession. 75% probability that we just continue to grow. Yes, things are going to slow. Hiring is going to slow. But it doesn't mean things are going to turn over. And I think one of the big takeaways about all of the data, Slowing doesn't mean stalling.
Well, it's the Fed that cares a lot about this rear view mirror data, which is why we have to talk about it, because, and as much as we've been trying to change their opinion of what they should be giving more weight to, whether you are Kathy Wood out there or anyone else who's saying, look at more forward-looking data here, or things that are actually continuously right in front of us here and playing out in front of our eyes. We got revisions in this report. We got more strength in some of these services producing sectors as well. What does it signal to you?
To me, it signals kind of very, very similar view in that the economy is not headed for a recession, certainly not in the first half of next year. I also think it's going to be hard for the Fed to be cutting interest rates in the first half of next year. I think it's going to be by Q3. At that point, the economy should be slowing sufficiently. Inflation should be heading back down to 2.5%. Totally echo the commentary around rent inflation coming down. It's very much baked in. By the time we approach the middle part of next year, core inflation should be at that 2.5% level, and then the Fed can feel comfortable cutting rates.
I got a first chance to look at the internals here. 3-month average annualized pace of average wage gains, it's 3.4%.
Yeah.
Right.
That's victory, people.
Right.
And also, by the way, this is the survey week was late in the month, which tends to boost the number. So we were actually looking for a number that was going to be a bit above expectations, purely for calendar effects. Last month it was quite weak at just about 0.2%. So if you sort of smooth out and look through a 3-month average, you're sitting at wage inflation that's not that far from the Fed's target.
We had 3.7% on the unemployment, or 3.8% on the unemployment rate. We had 187 on the top line. So we liked the number not only because of the forecast, but because of the underlying trend, which is cooling in hiring, cooling in wages, which supports the other inflation data that we're seeing. Again, this is what a soft landing looks like. This
You're
is
beaming
good
right
news.
now. I can see it in your eyes.
All
You're
economists
thrilled.
should be. We all should be, because the Fed went from 0 to 550 basis points. In past economic cycles, that would have just kicked out the legs underneath the table and the economy would have crashed. It's not. Now, we still need to get a good handle on why that is. I'm not comfortable talking about immaculate disinflation, but it does look a lot like that.
Well, Fed swaps are pricing in less easing in 2024 following this report. So I'm curious, what does that mean for the dot plot? What are you anticipating next week, Stephanie, as we get that dot plot in?
Yeah, I think that the Fed's going to have to be looking for a couple of cuts for next year, but they're not going to be anywhere close to what the market's expecting. That's going to be difficult.
What do you think? 2, 3?
I think they'll probably be putting in for 3 cuts for next year. They're going to have to take up their GDP numbers. They'll take down their inflation numbers. So from that perspective, their numbers are going to look a little bit more soft landing-ish, and then they can be looking for about 3 cuts, but definitely not where the market is.
Starting in June?
Yeah,
Sorry.
2 cuts are already embedded. We expect 4. Moreover, you're going to see the 2024 median dot come down to 4.875. Market will move on that.
All right, we got to leave things there for right now. Stephanie Roth, Wolfe Research Chief Economist, joining us here on set, as well as Joe Brusuelas, RSM Chief Economist. Thank you both so much for helping us break down some of these jobs numbers here this morning. Let's get on over to Jared Blickery, the Blickery Bop we got going on right now. Yahoo Finance Newsroom here for a look at how the markets are reacting to the November jobs report. Hey, Jared.
It's a bit of a bearish reaction here, especially looking at the stock futures on the Wi-Fi Interactive. Although the Russell 2000 futures, those have just climbed back in the green. And let's take a look at that overnight price action since midnight. You can see a few fireworks there, but nothing too major. Nasdaq, which was really strong yesterday, a leader, is down about 0.5% today. It is leading the way down. And the Dow is the least worst off here. That's down about 0.2%. Want to take a look at the bond market. We've seen depressed yields for the most part over the last 4 to 6 weeks, but for the last few days, they have been ticking up here. Now, these are 2-year Treasury note futures, so this going down means the rate is going north. You can think what you want about whether that's bad or good, but generally that does not bode well for growth stocks. And here's a 10-year. That's down even more, about 72 basis points. And just taking a look at gold, which has been really volatile lately, that took a leg down on this slightly stronger than expected jobs report. But is it enough to move the needle in terms of the longer-term trends here, the intermediate-term trends? It doesn't look like it so far. We do have to see what happens throughout the day. But let's take a look at the sector action right now. now. And I'm going to put on some of our pre-market quotes. You can see, by the way, yesterday tech was the biggest leader. Here's energy. Energy is up the most. That's up at 82 basis points. Real estate, materials, staples also in the green. But tech is taking the biggest hit here. Not surprising given the move that we've seen in the bond market. Looks like all the mega caps getting hit a little bit. Communication services down 0.2%. And here's the board. Here's the Nasdaq 100 board. Looks like most of these issues in the red. I'm going to sort by performance. We can see AMD continuing off of its monster run yesterday. Lisa Su just knocking it out of the park, up over 1%. Let me take a look at Bitcoin here. That has been an interesting market to watch. Suffice to say, over the last few weeks, last month since it's really picked up, here we can see not a lot of action around the report. Here's a year to date, just you can see up 161%. Looking at 45,000 here. The next stop, perhaps 50,000, but it's been a blistering pace so far. With respect to the jobs report, a little bit of a negative reaction on the hotter than expected numbers, but probably not enough to move the needle.
Jared, thanks so much for continuing to keep tabs on all of the movements that we're watching, especially coming off of this jobs report this morning. Appreciate it. Let's do a quick recap of the numbers that we got here this morning in the employment situation for the U.S. here in November of 2023. We've seen the actual non-farm payrolls number come in at 199,000. That is hotter than the anticipated 185,000 that was expected there. The unemployment rate, that actually ticked lower slightly. That came in at 3.7% versus the estimate and where we were last month at 3.9%. And then lastly here, average hourly earnings year-over-year markers, which you're looking at there, that essentially met expectations. On the other side of the break here, we're going to take a closer look at the November jobs report across industries. We're also going to be keeping a close tab on the major averages. As we take a quick look at those major averages, you're seeing the move right now continuing to point lower here, at least for the futures right now. We're about 45 minutes out from the start of trade here. You're watching Yahoo Finance.
We just got that hotter than expected jobs report for November. We've got some team coverage to break it down in a second, but first I want to recap these numbers here. Non-farm payrolls coming in at 199,000, beating the estimate, which was 185,000. The unemployment rate actually coming in at 3.7%. That's a little bit of a miss from the estimate of 3.9%. And average hourly earnings year on year coming in exactly at estimates at 4%. I want to point out, though, what our last guest told us right as he was walking off set, that the most important data point for him is the 3-month average annualized earnings coming in at 3.4%. That's softness, potentially feeding the soft landing narrative. So we're going to break down the details of each sector with our team coverage here. We've got Alexandra Canal, Jennifer Schomburger, Danny Romero, and Anjali Kemlani. We're going to start it off with leisure and hospitality. This year, travel booming thanks to revenge travel, where people were taking the trips that they held off on during the pandemic. Sure, travel rebounding this year, but is the sector starting to run out of steam? After being one of the most understaffed industries, what do the jobs numbers tell us? So here to break it down, we've got our very own Allie Canal. Allie, what do you got?
Hi, Maddie. I'm right outside the Yahoo Finance coffee bar, which is appropriate considering, like you said, restaurants, hotels, they have been the greatest job creators in this post-pandemic recovery. The expectation, though, was that we were going to see the sector decelerate, and that didn't necessarily happen last month. Digging into these numbers in November, employment in leisure and hospitality continued to trend up, with 40,000 jobs added last month, almost entirely in food services and drinking places. The sector had added an average of 51,000 jobs per month over the prior 12 months, according to the BLS. And this comes after it was little changed for the month of October. Just to keep things in perspective, though, in November of 2022, 123,000 jobs were added. So we're still quite low on a year-over-year basis. And I want to take through some of the other data points here, because average hourly earnings actually moved higher to $21.55 versus $21.41 in October, and just $20.61 in November of 2022. Similar to that headline rate, the unemployment rate in the sector also ticking lower to 5.5%, down from 5.8% in November 2022. So the narrative from economists had been that we were going to see this payrolls in this sector slow in Q2, reaccelerate in Q3 as we saw this summer services spending splurge, and then come down again in the fourth quarter. We saw that with the ADP figures on Wednesday. Haven't necessarily seen that in this jobs report that we got today, but the hope is that moving forward, we'll start to see that decelerate, because that has been really a very sticky sector when it comes to keeping that overall jobs figure pretty high right now. And we saw that did come in a little hotter than expected last month. So we're going to continue to track this sector as it's a very important one.
Yeah, it's one of the most fun sectors to track here. Thanks so much for joining. Allie Canal, Yahoo Finance reporter. Well, after 2 years of slower hiring in the public sector, the industry is playing catch up across the federal, state, and local levels in 2023. So what do the November numbers mean for government jobs, and what does that tell us? Joining us now with more, we've got Yahoo Finance's very own Jennifer Schomburger. Hey, Jen.
Good morning, Brad. While private sector jobs have been declining in recent months, as you saw in this jobs report, government jobs still being added at a strong clip as state and local governments look to backfill positions for teachers, police officers, and other public sector jobs that were left unopened as people had quit from during the pandemic. If you take a look at this jobs report in November, the government added 49,000 jobs. Most of that coming from state and local. If you look at those sectors, those adding 32,000 and 17,000 respectively for the full year. Looking at state, local, and federal government, the government has added 517,000 positions. Of that, 67,000 have come from the federal government. So again, more the state and local governments adding the bulk of the jobs here. If you look at the Inflation Reduction Act and the CHIPS Act, while those acts are creating jobs, the incentives in those acts are to create jobs in the private sector as opposed to the public sector. In speaking with EY Chief Economist Greg Dacko, he told me that he expects public sector jobs in the education and healthcare sectors to begin coming back into better balance over the coming months. We're not quite there yet, but he expects that trend to come sooner rather than later. Of course, if the economy were to slip into recession, government government jobs are not immune to that. I will have more next hour when I speak with Acting Labor Secretary Julie Su. Back to you.
All right, thank you so much, Jennifer. We're going to check in with Yahoo Finance health reporter Anjali Khemlani, live from the Sunshine State, my home area, Florida. Anjali, healthcare really driving this report. What else are you seeing when it comes to the details and the numbers?
Yeah, that's right. So healthcare has been one of the drivers actually for some time. We've seen that over the last several months. In fact, it has accounted for a good portion of the jobs that have been added. This time, nearly 40% of jobs added are from the healthcare sector, especially you're seeing that growth in the ambulatory hospital, as well as nursing home care in particular, big gains there. And that is a continuing trend as we see recovery from what was lost during the pandemic, but also an increasingly aging population causing that demand. So this is where you see that growth come from. I did notice that the pay kind of dipped a little bit, not very noticeable, largely flat if you look over the trend of the past several months. But it is something to note because we saw those outsized gain in that area during the pandemic, and this has certainly changed as we look at what the current trend is. It's also interesting to note that, at this time, we know that healthcare is going through significant shifts in where physicians, where clinicians are employed, and how many more of those clinicians are not doctors per se, but nurse care practitioners or physician assistants. And so these numbers just keep shifting to show that healthcare itself is going through a transformational time. And you're seeing those numbers support that idea that we're definitely going through a provider shift, if you will.
What does that say on the other side here? I know we're talking about the employment situation, but the employment situation is also driven by where consumer demand is, especially for services within the healthcare sector. What kind of read-through can we extrapolate here?
Well, it's interesting that, while they have seen physician numbers grow, they don't tell you where exactly that is. And I found that interesting when it comes to telehealth, for example, a really major portion of what we see as growth in the sector that has had, its ups and downs in the pandemic, really high demand. And then you've started to see sort of the normalization of it, if you will, and it's just sort of, a dime a dozen. You can just find telehealth companies out there and these physicians that are working for them. So that to me is a little bit interesting. I do wonder how much that is going to impact in the future and whether or not we're going to have a separate category too. That's something I've been waiting on.
All right, a whole healthcare hit, and we didn't even talk about weight loss drugs. Anjali Khemlani, thanks so much. Appreciate it. Well, let's head on over to Yahoo Finance's Danny Romero. She's in our newsroom. Danny, construction. Those jobs didn't show much progression last month. Your biggest takeaways on the sector?
Brad, if you're still looking for a construction job, you're hired. Yes, this report wasn't as strong as many analysts were expecting. They were expecting 15,000 to 25,000 jobs added in this sector. There still remains a lot of job openings overall. But what really stood out to me where we saw most of the boost was in the heavy and civil engineering. Remember, those jobs are our highways, our streets, our dams, our bridges, our airports. And that really got a big boost from the Infrastructure Investments and Jobs Act. Brookings reported that $306 billion out of the $850 billion that was awarded for these investment projects. So we definitely saw a big gain there. About 3,300 jobs were added in that. That really, really stood out to me. There was some weakness on the residential building side overall, which is a very interesting dynamic on what's going on. Could show that some developers are pulling back, whether that's multifamily or residential single family. I mean, single family, if we look at the reports, that there are still a big number of starts that are starting. So, there could have been some pullback there. Another thing, just to wrap this all up, non-residential specialty contractors, there is some risk ahead in that department. Developers, like we said, are pulling back. Some of the higher interest rates has really been impacting them on that front. We did see some weakness there. Like I said, they lost about 800 jobs. But again, the specialty trade contractors, if we look at the residential side, they saw about 2,700 jobs added there. And those jobs are our framing, roofing, pouring concrete, pouring into our foundation of a home. So definitely there was some momentum there. So that could be some good news looking ahead, Brad.
All right, Danny, appreciate the breakdown there. All things construction, very watched sector here, especially within this report. Appreciate it. Well, let's do a quick recap of the numbers that we got out this morning for the November jobs report. The headline print: non-farm payrolls hitting 199,000. That well above the estimates and the anticipation of 185,000 jobs added. Also, something that ran counter to the estimate was the unemployment rate. That came in at an actual reading of 3.7% unemployment versus the 3.9% that was expected, which would have been a carryover or a leveling from last month. So that ticked lower. And then also you've got hourly earnings, average hourly earnings year over year. That came in lockstep with the expectation here. We're continuing to track as well some of the futures activity this morning. We were pointing lower. We're continuing to see red across the board for the U.S. major averages. We are just outside of about 35, 40 minutes-ish until the start of trade here. So we'll continue to watch that very closely here. But the Dow, the S&P 500, and the Nasdaq futures all showing some marginal moves to the downside right now. We've got much more coverage ahead for you on the other side of the break. Stay tuned. You're watching Yahoo Finance.
Yahoo Finance is counting down to the biggest story of 2023, but what's going to take the top spot?
Whoa, Josh. Inflation is clearly the top story of 2023. Now, this pizza I have right here is supposed to be $18, but we're in New York City and I added pepperoni, so it costs, get this, $29.
All right, your pizza's more expensive, big deal. You might want to get that pie to go, though, because we all know the big story was OpenAI, ChatGPT, case closed.
AI was a big buzzword, Dan, but I think we're forgetting about a big event here. Remember that regional banking crisis back in March? Remember we had JP Morgan step in and buy First Republic? Pretty big deal, Brooke. Pretty big deal.
I'm kind of a big deal.
I think the banking crisis might win here.
All right, Josh, Brooke, Dan, I'm shoving you to the side because I think we're all forgetting about a small little cultural phenomenon known as Barbie. I mean, this is all anyone could talk about. 4 months, we're still talking about it. Very true. But guys, I think we're all right here. Stay tuned for Yahoo Finance, and we'll hear what the biggest story certainly is as we count down to 2024. Inflation.
Good morning, everyone. It's 9 a.m. here in New York City. I'm Brad Smith alongside Madison Mills. This is Yahoo Finance Live, and here's what we're watching this morning. November's payrolls report comes in hotter than expected. 199,000 jobs added. The unemployment rate unexpectedly fell, reflecting signs that the labor market isn't cooling as quickly as many had thought.
And China's latest move to boost its economy, leaders vowing to continue implementing proactive fiscal policies in 2024 to boost that domestic demand. That's coming after 2023's lackluster recovery. The world's second largest economy has a lot of work left to do in the new year, Brad.
Plus, UK watchdogs on the hunt here. Perhaps not a corgi, I guess. Regulators in Britain, though, are taking a closer look at Microsoft's partnership with OpenAI. The tech giant recently given a non-voting board seat at the startup, and officials are investigating whether the investment has more or less amounted to a merger.
And November payrolls coming in hotter than expected, signaling the labor market isn't cooling as quickly as many had thought. Again, just recapping that number quickly, the actual coming in 199,000, estimate of 185. I do want to do a quick look at the markets here for us because we are seeing a little bit of movement down to the red. I'm curious, I think volume is probably a little bit light as well, but Nasdaq down by 0.4%, S&P down a little over 0.1, and same as the Dow heading into the market open in about 30 minutes. But what does this report mean for the market outlook as we head into the new year? We're going to talk about that with our next guest, Brad McMillan, Commonwealth Financial Network Chief Investment Officer. And Brad, thank you so much for being here. What do you think the market is moving on most in this jobs report? What data point is most critical?
I think what the market's going to be looking at is the yield on the 10-year U.S. Treasury. And you can actually see that in the preliminary numbers for the indices. You know, we've seen the Nasdaq pull back a little bit more. One of the things that has really driven the recovery in last month, certainly, was the idea that the Fed is going to cut rates, that we're moving into a real slowdown. And what this jobs report tells us is not only do we not have a slowdown, in fact, to some extent, we have an acceleration. We saw monthly wage growth come in above expected. And when you look at that, you say, wow, that's not a slowdown that we can fade. And I think that's really going to hit rates, and I think it's going to hit the more interest rate sectors, such as growth.
And so, Brad, if this perhaps throws a hitch in the plans of the Fed, the market's certainly responding, and very clearly here this morning at least. What does that set up then for going into early 2024, where there have been some calls for even a first quarter cut from the Fed? Does that now kind of push this out or take that off the table entirely?
I think it does push it off. Certainly the first quarter was always a little bit optimistic for market participants. But I think bigger picture, what you've seen markets talk themselves into the idea that the Fed is going to cut rates. And we've seen this several times. You know, the Fed says we're not going to cut rates, the market freaks out, and then everybody looks at each other and says, well, they've got to cut rates, don't they? Yeah, I think so. And then the market goes back up, and then the Fed comes out and says, no, we're not going to cut rates, and the market freaks out again. So this is just a normal cycle, but the bigger picture is we're still in a sweet spot. We're still in a soft landing. So we may see some turbulence in the short term, but longer term, this is exactly where we want to be, and that'll be good for the markets.
Okay, it sounds like I'm hearing a soft landing, and I'm hearing ever so slightly a hint of an unspoken word that we've kind of banned from our industry, which is transitory, Brad. Are you seeing evidence in this report of transitory inflation at all?
I never got away from transitory. Transitory took longer than people thought. But when you look at the way it's played out, okay, the Fed got it wrong in terms of timing, but nonetheless, we're seeing the supply chain problems pretty much go away. We're seeing energy, for example, come back down. There's a whole bunch of things that are simply not persisting as inflation. And that's exactly, again, what we want to see. Now, does that mean we're going back to 2? I don't think so. But 3 is not a bad place, but it's not where the Fed wants to see. So no cuts.
No cuts. Does that mean that we see a recession at some point from your perspective in what we're seeing in the data and how that's showing up so far?
Well, certainly we're going to see a recession at some point, Brad. But the question is when. Mm-hmm. And I think what we've done in the markets and as an industry, we've kind of phrased the question wrong. It's not when is the Fed going to cut? It's why would they cut? As long as jobs are fine, they are free to concentrate on inflation. So we're going to see rates continue at about current levels, I would say, indefinitely until we do get a recession, and a severe recession at that. But the thing is, we don't see any signs of that. The economy is chugging along. People are working. Things are going well. Why would the Fed cut? We can grow at current rates. We have grown at current rates. I think we're going to continue to grow at current rates.
Okay, Brad, so if we're going to have a Fed put, as you're talking about that, then how should investors be playing it? What is your take on what our audience of retail investors should be doing today?
I think what we have to do is just see through the noise. I do a regular thing that goes beyond the numbers. And, the numbers are important. But the bottom line is what matters is the economy is continuing to grow. Companies are continuing to grow earnings. And I mean, that's the bottom line. If you look at expectations, earnings are going to continue to grow, and that's consistent with the economy. Sit tight. Don't panic. If you're a retail investor, keep putting money in. We're going to be okay.
Where to, Brad? If I'm asking for a New Year's resolution for you, perhaps, or a top idea for 2024, where should I be putting money into the market?
I think if there's a surprise out there over a 12-month time frame, it's probably in energy. Because what we've seen is energy get beaten down. We've seen oil prices drop. And we've seen a lot of things just hitting that sector hard. But at the same time, energy is not going away. And in fact, you can continue to make a lot of money in a slowing business environment. That gives an advantage to existing players, especially the big ones. I think there may be some opportunities there.
Brad McMillan, Commonwealth Financial Network Chief Investment Officer. Thanks so much for taking the time here this morning, talking all things jobs report, plus some top picks for 2024 as well here. We love it, Brad. Thanks so much.
Thank you.
Well, the China slowdown story rumbles on, but could the ruling Communist Party be about to take some big steps to boost domestic demand? The party's top decision-making body said that the country's fiscal policy must be moderately strengthened to stimulate economic recovery here. According to the nation's state-run news outlet, the Politburo pledged to do so through effectively enhancing economic vitality. And that extra vitality, could that be good for some of the U.S. companies that are dependent on growth here? That's the big question at the end of the day. And I think more largely, we've had to think about where the party would put stimulus into the economy in order to drum up everything from consumer sentiment and spending all the way into some of the larger B2B spends, which would be on construction, which would be on making sure that there's more hiring that continues to take place. Sure. And all of those things have been on the docket for discussion. It's just a matter of how much stimulus they decide is necessary to put into the economy as well.
Right, they don't want to have the sugar high that Jamie Dimon says was infused into our economy. But it's tough for China because they have these ghost cities coming out of the pandemic where construction had started but was sort of abandoned due to some of the volatility there. And now that's obviously not going to inspire a lot of consumer strength. So that's where the push for some of this stimulus is coming in from Beijing. But we also don't have the clearest picture of what Beijing is ever going to do, right? We know that, for example, when Moody's had their downgrade earlier this week, they reportedly had their employees staying home that day who were based in China due to some of the threatening volatility coming out of the region when it comes to things like downgrades from banks. So you have to wonder how clear of a picture we're really getting about what it's like on the ground given the safety issues there.
Yeah, spot on. And at the end of the day, we also have to consider for investors out there that are trying to play this in the right way, what are the companies that could be best positioned to benefit from this? And if there was stimulus that led consumers to feel more comfortable to spend, especially among some of the discretionary categories, one area is perhaps in athleisure. And that's where I'm looking at here. And I think no further than to Lululemon here, because that is a company that's top of mind for a lot of investors out there. Company just reported earnings as well. You're seeing shares actually down by about 2.8% here to begin the trading session. Well, it'll begin in 21 minutes. But at the end of the day, this is a look at some of the international growth that they have seen. They are so hinging on where else within the world they can continue to drum up even more of that international sentiment and the purchasing habits going directly into the brand of the wishbone here. And international was up 49%. They talked about Greater China within the earnings call as well here, saying that In Q3, all regions grew strong double digits, 53% increase though in Greater China, and they're keeping a close eye on the macro environment in China, but the business remains strong as of right now. So this is one potential brand that could see a strengthening in its business in, I might add, an area of the world that has a very strong yoga culture. So those the unicorn tears pattern might do extremely well over there.
Nice, Brad. I love when you bring up your on-the-ground knowledge of the yoga community in China.
What can I say? I'm good for a vinyasa every once in a while.
I love it. I love it. That's what we'll do when we wrap up our show at 11. No, but it's such a great point, Brad, and it mirrors what we're seeing with Nike, right? Because kind of the resurgence of sports in the area has led to increased sales for Nike, which the CEO has talked about on their earnings calls. We're seeing Nike down in the extended hours here over the course of the day yesterday, but this stimulus coming from China could be a boon for getting those sales up in the region, which is critical for the company because it's so oversaturated in the U.S. They have to look to international markets to get an expansion of their profit. And China, the world's second largest economy, as we've said, is a great place to be doing that, particularly as some of those luxury brands in the area are still struggling. Consumers might be more excited about putting their money to work with a Lululemon, with Nike. Now, that said, Brad, the CEO has talked about the geopolitical tensions, things like he said the non-0% chance that China could invade Taiwan as a risk, but he said it's just too big of a market to avoid and that avoiding it would be disastrous.
Yeah, I mean, look, at the end of the day, this is going to be a company as well that reports earnings, I believe, December 21st. It's one of those late earnings season reports that typically comes out, but it's going to be extremely watched across everything in the apparel, the footwear categories here, and just where they're seeing reception or taking on of some of that inventory around the world as well.
Yeah, Brad, I feel like you could be a Nike analyst with all your great sneakers.
I appreciate that. I appreciate that. You know, you got to think about where you're transitioning your career at some point or another. We're always in the state of evolution, if
always
you will.
in the job market.
Always
you know
reinventing
what I mean?
ourselves, yes.
Well, speaking of the job market, some really interesting...
I like my current job, by the way. Let me just throw that out there.
He loves Yahoo Finance, as we all do. But sticking with some interesting moves in the jobs market, let's got to talk about OpenAI. OpenAI going to be weathering another storm, not related to jobs this time. This time it's about those UK regulators wanting to review Microsoft's investment in OpenAI. And this makes the UK's Competition and Markets Authority the first major regulator to raise a red flag on this relationship. So let's bring in Yahoo Finance's Dan Howley to give us more details. Dan, thanks so much for being here with us. What do we need to know about the strength that the UK has in opening up this question? How big of a deal is this?
Yeah, Madison, I guess you could say this is kind of job related, mostly to Sam Altman's. Basically, the Competition and Markets Authority is looking at Microsoft and OpenAI's tie-up. They don't necessarily have a merger. It's a large investment that Microsoft has. But since the Sam Altman fiasco, where he was fired by the board and then Microsoft hired him, and then most of OpenAI's employees wanted to jump ship to Microsoft, and then there was some backroom talks, and Sam Altman was reinstated at OpenAI. Microsoft now has a non-voting position on observer position on OpenAI's board, and this seems to have really stuck with the Competition and Markets Authority. Right now, what they're doing is opening up a comment period to determine if this results in what they call a relevant merger situation. And if that's the case, they would then go forward with a full-on investigation into the two companies and their tie-up and whether or not it really is a merger and what that means for competition as far as AI goes. Now, Microsoft President Brad Smith got on Twitter, X, whatever you want to call it, and basically said that, look, we're going to continue to work with OpenAI, but we're also working with the Competition and Markets Authority. He said the only thing that has changed is that Microsoft will now have a non-voting observer seat on OpenAI's board, which is very different from an acquisition. And then he basically throws Google under the bus here. Very different from an acquisition such as Google's purchase of DeepMind in the UK. I mean, really just kind of digging that knife in. And he says, we will work closely with the CMA to provide all information it needs. You'll remember that Google had acquired DeepMind, which was, as Brad Smith points out, based in the UK. That is now Google DeepMind. They paired the two together, its own AI and DeepMind together to really catch up with what OpenAI and Microsoft are doing. But, from it seems the CMA's point of view, the two, Microsoft and OpenAI, are just fully linked now. And so they want to determine if that actually is a merger or it's just a really fun partnership for the two of them.
Yeah, exactly. Dan, I did my best Idris Elba impersonation while I was reading through this entire CMA watchdog oversight announcement that they made. I mean, it's really just kind of asking for comments at this point and announcing that they're going to do a further review. So we'll see what comes of it at this point and if I can improve my impersonations as well. Dan, appreciate it. Micron, we're tracking them this morning. They are striking a union deal for construction of its Idaho chip plant. It gives the semiconductor giant a chance at receiving a subsidy under the CHIPS Act, which has a preference for companies that make union agreements. The deal will cover about 3,700 construction workers that the company will eventually hire. This comes just a day after an Arizona labor union and Taiwan Semiconductor also reached a labor dispute agreement here. So a lot of focus on the chip space this week, whether it be in making sure that they're bringing on more capacity here in the States and tapping into some of the subsidies, or similar to the conversation in advancement around AI chips specifically. Our own executive editor, Brian Sazi, being able to speak with Lisa Su, who is over at AMD, and really getting a clear vision for what's taking place with regard to just scaling up to meet this GPU and the graphics processing unit and chip demand that they're seeing in the generative AI landscape right now.
And it's such an important point, Brad, too, in terms of the investment, because the U.S. has a lot of catching up to do when it comes to chip production, right? If we want to be at the forefront of this industry that, like you said, with AI requiring a lot of GPUs, we're going to need to produce a whole lot of chips. And news like this starts to allow the U.S. to lay the groundwork for actually participating in that global fight for chip production. Also, want to point out Senate Majority Leader Chuck Schumer saying that this is a good union play too, adding 3,700 not just jobs, but union construction jobs. So also a story about the continuation of labor, unionized labor as we head into the end of this year and early 2024, Brad, as well.
Yeah, absolutely. Taking a look at Micron shares here, and that is just a max chart if you wanted to go all the way back to the where were you wins of Micron's existence as a publicly traded company. But ultimately, taking a look at the year to date, this company has been able to move higher by about 47%. We're also tracking Bitcoin this morning, holding steady, hovering over $43,000. All on the back of the November jobs report? No, not at all. Come on now. There's much more at play. Can we expect the rally to continue, though, in the weeks ahead? That is the important thing here to continue to think about. Yahoo Finance's own Jared Blickery is at the Interactive with the details. Jared, tell me if I'm wrong. It can't be the jobs report, right?
There's been a whole lot of nothing going on in Bitcoin since the jobs report. Let me show you. This is a bit of consolidation, though it is at highs for the day. The real factor here that's been moving Bitcoin has been that spot Bitcoin ETF. All the rumors, all the incremental news on that has been driving it up over the last few months. Here's a 3-month chart, and I'll put some candlesticks so we can see. Typically, when you have a big candle like this, you might flag a little bit off to the downside. But no, the flagging was to the upside. This is just a market that wants to scream higher. I would note, however, that right around here in early October is when the dollar started turning down, and the dollar turning up again. It's not a big movement here, but that does act as a headwind. And just want to show you what's going on in Ethereum too. And let's take a 5-year look. And actually, I'm going to dial this down to 2 years. We have a pretty big breakout here from an important level. But as you can see from this 5-year chart, still a long ways to go to the very top here. I'll just show you Bitcoin as well. And when we think about price action, it's a lot about price memory here. Investors getting in at various prices in the past and also wanting to get out at break even. That's a huge theme with shorter term short-term traders, and when people get back up to that level from which they originally purchased Bitcoin and they've been in the hole for the last 2 years, well, a lot of people are going to sell. And so that's what the headwinds are for Bitcoin, but we haven't seen that as a big factor just yet, just an incredibly strong short-term rally. And here's that same look in Ethereum. Let's take a look at crypto stocks and see what they've been able to do. This morning, we got a few names in the green. Riot Blockchain up 2.5%. I'm going to take off these pre-market quotes to make things look a little bit more cohesive. And here we have over the last 10 days, a lot of these stocks just screaming higher. Bitfarms, that's up 84% over the last 10 days. And let's put a year-to-date chart. You can see really how it just took off rather recently, not even when Bitcoin took off. So a lot of these stocks are just laggards playing catch up. And these stocks, they got a ways to go, but I'll tell you what, last time I looked at Marathon Holdings, it was a much different chart. So a lot of gains being made here, but also a lot of gains to be made in the future if they can work through that price memory that I've been talking about, guys.
Jared, I want to ask you about Bitcoin's role in a potential balanced portfolio moving forward. I mean, since that March 13th low, Bitcoin has doubled without ever falling below that March 13th low again after we all know what happened. Jared, what do you look to determine whether or not the street is going to view Bitcoin as a key part of a good portfolio moving forward?
Well, I think it speaks as to the institutionalization of Bitcoin. This is something that's been happening over the last 10 years. I went to a Bitcoin conference in 2013, and it was the Wild West. It was a pretty interesting event. Now it's people in suits. It's very business-like, and that's the way it was a few years ago. But with the latest crypto washout, the remaining survivors, I think there's a lot of business being built back into the ecosystem here. And if we are indeed in a crypto spring, and I think it's hard to deny that we are way out of that crypto winter from those doldrums that we had, as you said, down in March of this year. If we are out of that, then there's probably a lot of smooth sailing ahead. Actually, I'm going to change that. Not smooth sailing. This is Bitcoin.
Right.
But there's a lot of sailing ahead here. I'd be really surprised if Bitcoin never took out its record high. And, we could have some stumbling blocks with the interest rate situation in the U.S., but the move has been made.
All right, Jared. Well, thank you so much for that. I love the indicator you mentioned there of what outfits Bitcoin folks are wearing to conferences. Really appreciate it. We're going to have all of your markets action ahead, so stay tuned. You're watching Yahoo Finance. Krispy Kreme touches down in France this week. Big breaking news for us here at Yahoo Finance. Will the donut giant succeed in the country? Will it eventually say bon voyage to the high-class dining capital of the world? Well, we got some on-the-ground reporting saying that 500 people were waiting in line overnight for the donut chain's grand opening. Not exactly a huge surprise that the French are excited for the chain. The country is the second biggest market for McDonald's. So a little bit of a key indicator there, Brad, but we've been joking all morning about whether or not the French would be excited for Krispy Kreme.
They love this.
But they loved it. I mean, the lines overnight, right? And the stock is obviously up, and it's a great point that you've got the economic indicator there of McDonald's doing so well in the area. This stock is up on the year as well, and they're in the green ahead of the market open too. But Krispy Kreme doing well in France.
Yeah, move over the baguette and hello, manger le donut. At the end of the day, they talked about this strategy that they have, the recent ICR conference that they presented at, and investors should be keen on exactly where this company is going to be looking to lean into what they have as 99% global brand awareness, and that's showing up in this launch in Paris. But more seriously here, expanding omnichannel availability here, increasing the purchase frequency, and then this hub and spoke productivity that they talked about. And it sounds like there's going to be a lot of kind of the digital realm that they're continuing to invest in as well here in near term, and then also improving capital efficiency here. But this company is already in about 31 countries, so that key to remember. But this is a core offering that they can potentially bring into Europe as long as they can scale up what they call and what they have leaned into is a delivered fresh daily approach here, especially in North America and in the United States. That's what's been so successful. That's what's been able to get them so many fresh access points. That long-term goal is about greater than 15,000 new fresh points of access here at the U.S. They already are in about a 450,000 kind of footprint of grocery, convenience store, quick service restaurants, and other kind of assorted areas as well. So at the end of the day, that's why this story is so serious. So don't sleep on the donuts out there. This is serious business for over at Krispy Kreme that's had a year of leadership changes, new market entries, and always some very festive donuts that they announce every single season here. Have we ever seen a Krispy Kreme Grinch donut? I don't know. We'll table that. We'll come back to that one.
You gotta get on that, Brad. I think you need to write in.
They always have something special for the holidays. I don't know what they have this year. I haven't looked into that. I get the alerts.
First in line.
I get I'm on the RSS feed for some of the Krispy Kreme investor news that comes out here. Yeah, I know. It's one of my favorite ones. Also here, let's talk about another stock that we're watching this morning. DraftKings. They're facing a lawsuit alleging the company's advertising is unfair and deceptive. The Public Health Advocacy Institute saying that the sports book's promotion of a $1,000 bonus bet offer was misleading because to obtain that amount, customers need to deposit $5,000 and then wager $25,000 within 90 days. You do the math there. The Institute saying that the ad was deceptive to its target customers who are likely new to sports betting and probably won't understand the gambling lingo here in the fine print. Now the promotion is being offered in 22 states from July through the end of this month here. So this just points back to some of the larger customer acquisition costs that these companies have all acknowledged, whether it be Flutter, whether it be DraftKings, and all of them need to bring on new customers, especially in different regions that get greenlit for them to be able to bring a digital first type of component in sportsbook into those regions where sports gambling continues to be legalized or put on the docket and voted for in legalization. There's still some key states that are set to come online, and those marketing costs could skyrocket if they're looking to acquire even more customers in there.
Right. Well, to your point, Brad, the regulatory changes, companies are having to really catch up here. It started obviously just in Nevada. Now we've got 37 states legalizing sports betting, and that kind of regulation is being written live here. But the street not necessarily caring much about this news. Year to date, this stock is up 210%. It is vastly outpacing the S&P 500 with yearly returns, obviously, on that. 72% of those who have a rating on the stock as well have a buy, only 27% have a hold, and 0 sells. So this is clearly a stock that people are excited about given those returns. And we didn't even really see a dip, too, when ESPN launched their competitor to DraftKings. So it still just maintains a lot of dominance in the market of sports betting here. And that's why we've seen this stock just continue to outperform year over year here, Brad.
Absolutely. Hey, it's time for the opening bell on Wall Street. We were taking a look in the bottom corner of your screen right there at the company ringing the opening bell here. My squinty eyes aren't quite working here this morning here. So AEO, I hear, is ringing the opening bell over the New York Stock Exchange. Okay, good for them this morning. We're seeing mixed markets to start off the day. The Dow, the S&P 500, and I believe the Nasdaq is going to be calibrating, actually. That was yesterday's move. Now this is today's move. We're seeing it down by about 0.4%. Let's get on over to Yahoo Finance's Jared Blickery. He's standing by at the Wi-Fi Interactive, decided to make the long trek over from the newsroom to get on over to the touchscreen here, Jared.
I'll tell you what, it's a long journey, but I'll be just fine. Let's check out the index action here. The Nasdaq is the worst off, but we'll start with the Dow. It is down 41 points. And here's the last 2 days. You can see we got a nice little pop yesterday. Really benefited the Nasdaq the most, and just giving some of that back right now. Here's the S&P 500. Not a lot going on. In the Russell 2000, again, this is a 2-day view. It has been the most reactive and the most bullish off of this. It is at a 2-day high. I want to check out the bond market real quick because we did see a big pop up in yields off of that report. 10 basis points. That's nothing to sneeze about. And let me just take a look at the 3-month chart. The trend, the short-term trend, has definitely been down since we hit 5%. Almost hit 4%. That's a huge move. And one of the things I'm tracking here is bond market volatility. And here's the MOVE index. This is like the VIX for bond markets. It is elevated from recent highs. We got a little red candle from yesterday. This is not real time. This is only as of the close, but it does indicate that bond market volatility is increasing. That has been one of the biggest headwinds for equities all year long. Here's a look at the US dollar. That's up slightly. That could also act as a headwind. Just want to check out the sector action real quick. Energy in the green, so is materials, industrials, utilities. Real estate, the biggest loser there, but consumer discretionary is still behind. Both of those down about 0.5%.
All right, Jared, thank you so much for breaking down the market action for us. We appreciate it. We're going to move over to a specific name here with Lululemon shares extending losses after the company's holiday outlook disappointing investors. The athletic clothing retailer said it's expecting net revenue to be between $3.14 billion and $3.17 billion for the fourth quarter. That is just shy of the $3.18 billion analysts were looking for there. Still, Lululemon's CFO, Megan Frank, saying they're pleased with what they're seeing in the holiday season so far. So we're going to break down the kind of discrepancy between those things here with Adrian Yee, Barclays Consumer Discretionary Senior Analyst. Adrian, great to speak with you again. Thanks so much for coming on. Talk to me about what I'm missing and what the street might be missing when it comes to this earnings report. The full year guidance not looking great. What are you focusing on?
The entire earnings season for most of the retail sector has really been about positioning going into the earnings. Lululemon is the last of our retailers to report, and the expectations have just gotten more and more heightened as we have gone through earnings. I think that what's important to remember here is the company is guiding to effectively kind of 13-14% top line growth in a holiday season where the National Retail Federation is basically looking for 3 to 4% total growth. So they are well outpacing the overall market, and they're taking share. Their consumers are spending at Lululemon. And remember, they beat the current quarter materially, both on gross margin and all the way through the operating margin as well as sales. They tend to be conservative, right? So this tends to be a conservative management team. They did talk about 2/3 of the holidays still ahead of them.
And so what was also interesting on the call, Adrian, and always love to get your insights around Lulu as well as the rest of this kind of athleisure landscape right now. It was interesting to hear them mention a younger consumer, and it really was eye-opening for me because a light bulb went off and I had to say to myself, they're not talking about you anymore. They're talking about these Gen Zers out here. So what are they seeing in the spending capacity of that younger consumer cohort, and how do they effectively keep going after them in order to make sure that they're staying kind of in the higher sentiment rankings and continuing to see more of a customer lifetime value and more purchases there?
That is a fantastic point. And that is the point that we have been making kind of throughout the pandemic, past 4 years. During the pandemic and even pre-pandemic, the younger cohort, right? The millennial and then the Gen Z. And I mean, look, the oldest Gen Alpha is 13 years old, right? She's about to step into kind of that buying kind of lifetime value that we talk about. So even though these consumers may not have as much money, right, as their kind of like 30 to 40-year-old counterparts, what they are doing is they are creating such intense loyalty. And one of the biggest cohorts, as you say, that is kind of new to the brand is really kind of that 20-something-year-old kind of fresh out of school. And that's extremely important for the brand. They're doing a fantastic job on social media. They're actually investing in brand awareness advertising because they are still only about 25%, believe it or not, unaided brand awareness in the US. And so these are the types of things that give us such great confidence that they can keep going here. And again, as I said, remember, the stock is up 22% since the last quarter, well outpacing the S&P, the XRT, and any other index that we want to talk about.
Adrienne, while we're talking about the consumers that Lulu is getting it right with, we also got to realize something that they said on the call could perhaps come off to investors as alarming, and that is the fact that in the men's category, they're seeing some trends that are perhaps typical for when there is, at least in the consumer mindset, more of a cautionary environment, and they saw some slippage potentially within the men's that could have a larger ranging kind of implication there. Is that cause for warning, or is this company going to be able to navigate that effectively and make sure that they're continuing to kind of move through with a lot of the kind of touch bases or touch points that they have with men who are purchasing with this company?
Yeah. So the data point that I'll point to there is men's was up 12% during the quarter, women's was up 15%, accessories was up 29%. So not too shabby, but to your point, Calvin McDonald, the CEO, absolutely did point out, he said, look, men in a tougher economic environment may be more judicious with their spending. We know historically, even in the best of times, that men come to the market fewer times, they are more price sensitive, and they don't shop as much. Right? They do kind of batch shopping, if you will. And so I also think that they came out with a couple of new things, steady state and soft jersey. And then on the women's side, they came out with so many different categories, right? So they are still 75% female driven, and it is something to watch for. And I think the two things, if you were going to really nitpick at the quarter, were kind of slightly below fourth quarter guidance, trying to be conservative, which, by the way, we think they're going to end up beating. And this comment, right? This very frank comment about kind of just general male shopping behavior. I don't think it's something to be alarmed about. I think, when we see kind of a better shopping environment, they are bringing newness. And let's not forget, footwear for men is launching in spring of 2024. So let's see what happens.
Adrienne, one other thing that I noticed a lot in the call was this discontinuing of the Mirror partnership, starting up this Peloton partnership. I know they were draining a little bit of cash on the Mirror product, but Peloton is down 25% year to date. Is that a concern for investors?
It should not be. What I will say sort of diplomatically, I think this is a very graceful exit from an acquisition that was probably made at the peak of the in-home exercise trend. I think that the greatest thing about this company is that when they see perhaps investment that maybe wasn't living up to expectations, they quickly change course. And I love that about this management team. They try a lot of different things. That's how you get growth. Some of them will work and maybe some of them will not. This is expected to be less than 5% along with footwear as a component of their 5-year long-range plan. So if you think about it, this is a low single-digit part of the growth strategy to get to north of $12 billion. And so I actually look at it and I say, you know what? They're cleaning up things. They are the singular apparel partner to Peloton, and Peloton will provide their the digital content. And I think that's a great way to stay in the mix. But at the end of the day, they sell product, right? They're 99% product business.
All right. Well, they're going to get me on the Peloton platform whenever I see one of the instructors just wearing the rest feel slides, maybe doing a whole workout, because that's what's going to sell me. If it's something I can do in some slippers, then I'll do the workout. Adrienne Yee, thanks so much for taking the time. Always a pleasure to get your insights.
Happy holidays.
Happy
Great
holidays.
to see you.
Great to see you too. So a mixed picture on the data front, but how are individual investors feeling? According to the latest AAII survey, individual investor pessimism, it surged after having fallen to almost 6-year lows. Individual investors feeling pessimistic on a 6-month outlook for stocks ticked up to 27.4% here. A lot to really break down, but a myriad of different factors, I think, going into 2024 that investors really have to think about. And for all of the people out there that have been watching the program and having me, get people's New Year's resolutions, I think there is a consistent theme that's showed up that a lot of investors have to consider, even with the headwinds of geopolitical uncertainty that's rattling some CEOs out there, even with the larger question of what will be the major catalyst. Can AI still be a major catalyst going into 2024, and what's the next leg of growth that's going to be exhibited? I think one area that's been continuously interesting to hear about is small caps, and I think I would be interested in seeing where individual investors might even be heeding some of that advice or listening in to some of the largest firms with assets under management and saying, you know what, maybe there is a play for small caps going into next year as well. But right now, it seems like all the fervor is just around AI.
Around AI, but also sort of starting to be a little bit of agreement on the street that if we're going to get the gains that some of these banks are calling for, you're going to have to see growth in other sectors. You can't continue to rely on 7 names to lift up the S&P 500 by 70% year on year on year. Those other 493 names are going to have to come into play here. Now, what's interesting in some of the other notes this morning, and we are starting to kind of see this play out in the markets after that jobs report, Hartnett saying from Bank of America that rising bond yields would be a drag on stocks. That's a flip of what we had before that jobs report this morning, and that those yields supporting a rally in equities would basically mean that bad news would be bad news, which is what we saw a little bit of when the market was digesting that jobs report. Also looking at Marko Kolanovic saying that he got the call wrong in 2023 that we would have this slowdown. So kind of saying straight out in his note, I got it wrong. This coming year, maybe we actually will see a little bit of a slowdown. I love when they say.
Very noble.
I love when they say.
Yes,
you know what I mean?
Very honest.
Yeah.
We can't be right all the time.
There you go.
Yeah.
All right. Well, we're going to get all your markets action ahead, guys. Stay tuned. You're watching Yahoo Finance.
Solar stocks have gotten decimated this year amid high rates and razor-thin margins and an important owner incentive change in California. But are these stocks oversold and bound to rally in 2024? Yahoo Finance's Inez Ferre here with more. Hey, Inez.
Hey, Brad. Yeah, there have been headwinds this year for solar stocks. Part of that has to do with the higher interest rate environment. This makes projects much more expensive. So owners to front load also these costs for installation of solar power panels. That has been very expensive. The other issue that the solar stock environment has faced is also in some areas of the world a glut of panels coming from China. So you've got a bit of an oversupply. And then you also have that policy change in California, which you mentioned earlier this year, which are less incentives for owners of solar panels. So how does this translate? Well, we have seen these stocks getting completely decimated. The global solar ETF is down about 40% year to date. And Citi recently wrote a note basically forecasting that you are going to see, though, in 2024, more installation of solar panels. Citi also talking about SunPower, which is down about 70% year to date. Altus Power also down about 13% year to date. These are some stocks that they are saying is a buy. Morgan Stanley today upgraded for solar, talking about the IRA, the Inflation Reduction Act, that is going to drive clean energy growth, and also talking about cost deflation in clean energy equipment going into 2024, guys.
And as I can't let you go without talking about the oil moves. I've been obsessed with them all week. Prices bouncing back a bit, still on course for the longest run of losses in 5 years here. As the market is kind of weighing these OPEC plus cuts, whether or not that's going to continue, what do you anticipate the oil story headline being heading into 2024 when the price of oil is incredibly watched, particularly by those in D.C. as we head into this election year?
Yeah, and DC has been very happy, by the way, that the price of oil has been coming down, that the price of gasoline has been coming down. That's very, very important to voters. As far as where oil is going to be heading going into 2024, you've got some more bearish calls out there, like Citi saying that oil is going to be in the low 70s by the end of next year. Then you have some other analysts that are calling for oil around $80 a barrel. But I think what will be very important is to watch OPEC plus and those cuts that they have announced, the deepening of cuts. The market does not believe that they will go through with all of the cuts that they have talked about, because they see the deepening of cuts that were announced last week to be more voluntary in nature. What's very interesting, it's what happened this year where you saw the supply squeeze, where you saw oil prices rallying in the third quarter of this year, and then you saw oil coming down. It's now at a 7th week of losses, heading towards that 7th week of losses. So it's interesting that OPEC Plus has really tried to keep a pricing floor on oil. They need oil to be, some of these countries need oil to be around $80 a barrel to fund their internal projects, but they haven't been able to do that. And so much of this has to do with supply, more supply in the market, and then analysts are watching demand out of China. China is the largest consumer of energy. So if you see China slowing, as there have been signs of China slowing, then you will see an impact on oil prices to the downside.
And Inez, you got to wonder how that stimulus out of China is going to impact that. Inez, thank you so much. We really appreciate you breaking that down for us. We're going to have all your markets action here ahead. But first, an hour is a long time in news. So imagine how long a year is. It'd be almost impossible to get a list of every top story in 2023. But somehow our amazing team did it. Inflation, obviously an issue, but the ruins of the FTX fallout, still an issue too. The plastic doll from 1959 turning into one of the biggest box office smashes of all time. And of course, the Queen, Taylor Swift, singing all through it all. Was she number one? Did she make the list at all? What about that regional banking crisis? It feels like all of it was 100 years ago, but that was just in March. So tune into Yahoo Finance's Top 10 Countdown for the stories you loved and the ones you couldn't get away from. That's all coming up on Monday. Stick with us. You're watching Yahoo Finance.
Yahoo Finance is counting down to the biggest story of 2023. But what's going to take the top spot?
Whoa, Josh. Inflation is clearly the top story of 2023. Now, this pizza I have right here is supposed to be $18, but we're in New York City and I added pepperoni, so it costs, get this, $29.
All right, your pizza's more expensive, big deal. You might want to get that pie to go, though, because we all know the big story was OpenAI, ChatGPT, case closed.
AI was a big buzzword, Dan, but I think we're forgetting about a big event here. Remember that regional banking crisis back in March? Remember we had JP Morgan step in and buy First Republic? Pretty big deal, Brooke. Pretty big deal.
I'm kind of a big deal.
I think the banking crisis might win here.
All right, Josh, Brooke, Dan, I'm shoving you to the side because I think we're all forgetting about a small little cultural phenomenon known as Barbie. I mean, this is all anyone could talk about. 4 months, we're still talking about it. Very true. But guys, I think we're all right here. Stay tuned for Yahoo Finance, and we'll hear what the biggest story certainly is as we count down to 2024. Inflation.
Let's do a quick check of the markets here as we're about 23 minutes into trade on this Friday, jobs day. Everybody, woo-ha. All right, Dow Jones Industrial Average, you're seeing that flat, but to the upside right now. That's in the green by about 0.06%. S&P 500, flat as it gets by a hair of its chinny chin chin at this point in time, 1/100%. Nasdaq Composite, though, still in the red. That's down by about 0.1% right now. Taking a quick look at the sector activity. I've got it pulled up on the Wi-Fi Interactive for you folks at home, so you don't have to do anything. Don't lift a finger, don't move from the couch or wherever you're walking around watching us on your cellular device. Anyway, taking a look at the major average or the S&P 500 sectors here, we are mixed. Pulling up the caboose, you've got staples, that's down by about 0.5%. But leading the charge, you've got energy, that's up by about 0.8%. Looks like 6 out of the 11 sectors are in positive territory right now.
Well, Brad, I also quickly want to talk about treasuries, right? Because we've got the U.S. two-year yield jumping 11 basis points to 4.7%. Dollar is also up, but seeing across the board some of those treasury yields climbing. After that hotter than expected jobs report, we've got the chart right here on those treasuries, a little bit more of the long-term look there, but seeing green on the screen when it comes to the treasuries market, which could be what's dragging down some of those big tech names today, Brad.
All right, we're going to continue to watch all of that. We've got plenty more time left in the trading activity here on the session. The labor market, though, that in focus this morning, adding more jobs than expected in November. Unemployment fell to a 4-month low at 3.7%. The Biden administration has touted the year's relatively robust labor market as a sign of the success of Bidenomics. For much of 2023, strong jobs numbers translated into consumer resiliency, complicating the Federal Reserve's efforts to fight inflation. That strength still showing up in the latest jobs report. Let's get on over to our own Jennifer Schonberger in Washington, D.C. Hey, Jennifer.
Hey, Brad. For more reaction to this morning's jobs report, I want to bring into the program Acting Labor Secretary Julie Su. Secretary Su, always great to see you. Thanks so much for joining me.
Thank you.
So looking at this morning's jobs report, stronger than expected, but a lot of it driven by the government sector and also replenishing on the manufacturing side with the strike. Do you think it perhaps under the hood it's a bit of a cooler report, and we've seen private sector jobs also slowing? Do you expect that trend to continue into next year?
No, I mean, I think this is a strong report, and I'm not going to get tired of coming here and saying that it's reflective of Bidenomics working, and it's 199,000 jobs last month. We also have the lowest unemployment rate for the longest period of time since Diana Ross topped the charts. So it's 3.7%, that ticked down from last month's 3.9%, but we always look at broader trends and what that means. It's also broad-based recovery, right? Multiple industries are coming back. And, overall that means, it's 14.1 million jobs created since the president came into office, combined with low unemployment, combined with, wages going up and labor force participation rate and inflation starting to come down. Those are all exactly what the president wants to see in a strong economy that's good for the working class and the middle class.
We saw retail employment drop in November. Businesses have said that they're hiring fewer workers for the holidays. Ominous sign going forward?
No, I mean, the real story here is that consumer spending remains strong. People are buying things and they're getting them. And again, reflective of the broader health of the economy. We saw growth in leisure and hospitality. People are traveling to see their aunt for the holidays. They're going out to restaurants and bars. All signs that people not just feel confident, but have a little bit of that breathing room the president talks about, right? Are able to do some spending. The other thing is that in retail, right, this is reflective of other trends. We see, online shopping has grown. That means fewer people going into department stores. So I think, there's other things that factor in here. But just remember, a couple years ago, around this time, we were talking about, we would have to cancel Christmas because of the supply chain issues that we were seeing. Ships lined up at the ports, not able to unload their inventory. And we don't see that now, right? We have had it with a laser focus addressed supply chain issues so that, again, people are buying things and they're getting them. And part of that ties to how when workers do well, the economy does well. Right? Across the supply chain, we've seen from dock workers to delivery drivers to auto workers going to the bargaining table, entering into contracts that provide for long-term their security, but also the stability of their industries. And that's what the president means when he says, when workers do well, employers prosper, and the nation is stronger.
Micron striking a deal this morning, a union deal for construction of a $15 billion chip-making facility. 37,000 construction workers are going to be hired, the majority of those coming from unions. At the same time, more than 1,000 workers at Volkswagen's Tennessee facility now voting for representation from the UAW. What does this mean for union membership in this country going forward? What is your outlook? What's driving this? How much of this is being driven by the CHIPS Act?
We are seeing a moment in which workers are doing better. Right? This is a tight labor market. That doesn't happen by accident. It happens when you have economic policies that prioritize the well-being of working people, something that the president says and does every single day. That has meant that, part of this is unions, again, bargaining at the table for historic wage increases, for retirement benefits, for security, but also for health and safety and staffing and other things, from hospitality workers to healthcare workers to Hollywood. And so this is a moment in which there's broad support for unions, both from workers and also from the public. And so companies are seeing the benefits too. So Micron entered into an agreement where they're going to use a project labor agreement for its construction. That means that there will be construction workers who are paid good union wages, who are, have the security and stability that comes with that kind of job. And it is being driven by the enormous federal investments that the president's leadership has made possible so that we have construction, we have manufacturing, we have clean energy jobs in communities, and that those are good jobs that can help a family to raise a family and have a family sustaining wage.
So do you expect union jobs will increase over the next year?
Yeah, I mean, we've heard that, right? We've heard not just union leaders say that they're going to organize, but also workers saying, we're interested in having the kind of voice at the table that a union brings with it. And part of that is, one other thing that's happening is while workers from unions are seeing better contracts and more security, it's having an effect outside of the unionized workforce. So again, going back to the UAW, you mentioned, Volkswagen and workers organizing. After the UAW reached its historic agreement with the Big Three, we saw non-union employers also increase wages, sometimes in double digits for non-unionized workers. And that's a sign that, again, what's good for workers and what unions bring about in terms of the well-being of workers also has effects elsewhere. And I think other workers are saying, hey, we want a part of that.
And to your point and the fact that you said that you don't think what we're seeing for the holiday shopping season is an ominous side for the labor market, how does this bode for the administration's outlook for the economy? Because you're painting a very strong picture.
Yeah, it bodes well. I mean, this is Bidenomics in action, right? This is what the president has said from day one. If we invest in America, and we invest in America's workers, if we build strong roads and bridges and make sure clean drinking water flows out of every faucet and provide reliable, affordable internet in every home, we can also create good jobs in those communities. And everyone knows, right? A good job changes lives. A good job transforms families. And so this is, again, record levels of job growth combined with low levels of unemployment, combined with high labor force participation rate. All of this is what we'd want to see in a strong, stable economy.
So yes or no, no recession next year?
I mean, I'm not going to predict, but we've defied expectations every single month that we've been here. And we're hopeful that if we keep doing what we're doing, continue to make progress, we're going in the right direction.
Secretary Sue, thanks so much as always. So appreciate it.
Thank you.
I'll send it back to you guys in New York.
All right, Jennifer, excellent stuff there. Thanks so much for bringing us that conversation.
Thank
Everyone, we've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Welcome back. You're watching Yahoo Finance Live, everyone. I'm Brad Smith alongside Madison Mills. This morning, we are about 30 minutes into the trading day. Stocks searching for direction after the November jobs report came in hotter than expected, complicating the debate over interest rate cuts early next year.
Yeah, and the hits keep on coming for Spotify, not talking about music, after making its third round of layoffs for the year, cutting 17% of its staff. The streamer also seen its marketing and financial chiefs stepping away. The CEO, Daniel Ek, said in a statement that Spotify needs a CFO with a different mix of experiences, Brad.
And the prolonged slump in global demand continues to chip away at Taiwan Semiconductor. The world's largest supplier of made-to-order chips recorded a 7.5% drop in revenue in November. Revenue for the first 11 months of the year was down 4.1% from the year prior. In the company's last earnings call, the CEO said the worst could be over for the chip market very soon.
And Honeywell, adding to the recent M&A news here, finally seeing a little bit more deal making, striking a deal to buy air conditioner maker Carrier's security business for $4.95 billion. That acquisition, part of Honeywell's commitment to using at least $25 billion over the next 3 years toward M&A to expand its portfolio. Definitely a sign of a little bit more deal making to come, Brad.
That's right. All right, we've got to get to the latest on consumer sentiment that has just come out this morning here. We've got a fresh reading, and ultimately the consumer sentiment has moved higher in the month of December. It's up by about 13.2% month over month here. And this is particularly interesting because now you're getting kind of two parts of the Fed's calculus, where we've gotten reports out this morning, both on the employment situation front and now on the consumer sentiment front. And particularly as we think about where consumer sentiment is going to continue to move from here, it's a larger question of, do they continue to see the jobs print that we got out this morning and look at the employment situation and see strength there to say, all right, well, we feel comfortable spending. And that's been the larger question that many of the economists that we've spoken with have brought up in our discussions as well.
These inflation expectations, a huge headline here. 1 year views of inflation expectations dropping to 3.1% from 4.5%. Obviously, a hugely bullish indicator for the markets. That's why we're seeing a lot of green on your screen after there was a little bit of meh following that jobs report, but definitely seeing some movement, a we're so back narrative starting to come in to markets here. You're seeing the Nasdaq up 0.3%, mirroring the S&P there, and the Dow up by 0.2% as well. So that November jobs report coming in hotter than expected, adding 199,000 jobs, well above that 185,000 expectation. We've gotten a lot of labor data this week showing that things might be cooling off. So where does that leave this soft landing narrative? For more insight, we bring on the one and only Steve Stosnick with Interactive Brokers, and he is their chief strategist. Steve, talk to me about these inflation numbers that I was just breaking, because is this like too good to be true? You can really pick whatever data point you want right now to go with whatever narrative you have with this market.
Well, we've always had that ability. First of all, good morning, Madison. Good morning, Brad. But yeah, the market's always been somewhat malleable in that regard. Is, you know, we'll pick the narrative that suits us, and at this point, we've been able to morph pretty quickly from, you know, soft landing, worried about hard landing, to now soft landing, worried about maybe we'll get no landing. Mm-hmm. But the one thing I will say about the consumer sentiment numbers regarding inflation is they're typically pretty well tied to the price of gasoline at the pump. And it's interesting because for the last couple of months, they were not coming down even as pump prices were. And I think it's as though this month people noticed, hey, wait a minute, gas got a lot cheaper. Right. And I do think that had something to play into it.
So the prints that we got this morning, whether that be on consumer sentiment front or whether that be on the employment situation, do any of these readings and the trend that we're seeing more broadly, does that signal to you recession?
As of now, these numbers do not signal recession. If you've got a buoyant consumer, if they have jobs, you know, if the vast majority of people who want a job can get one or have one, we saw continuing claims fall. These are all positive numbers. Now, the question for the markets to reckon with is, Fed funds futures had priced in 5 rate cuts for 2024. This is not consistent with 5 rate cuts coming down the pipe. This was, you know, since the last Fed meeting was November 1st. On November 2nd, we were pricing in 3 rate cuts for 2024, and the first one probably starting in June, more likely July. Now we went, as of yesterday, we were at 5 rate cuts, with the first one likely starting in March, and if not, then May.
Right.
So things had changed a lot, and now we have to see that narrative unwind to some extent, and we'll see if Powell pushes back on that next week.
What does that unwinding look like today for those that have gone with the 5 rate cuts, pricing and narrative? What are they doing today to rebalance?
What you'll start to see, and I'm surprised we're not seeing it a little bit more, is a pullback, let's say, in shorter-term rates, like the 2-year. You'd start to see them back up as those rate expectations come out. Those markets don't react quite as instantly. When I look, before I came on air, they backed off some of those expectations a little bit, but not fully. I still have to wonder whether, how does Powell approach this? Does he sort of have his usual sort of Goldilocks stance, at the FOMC meeting where we get a little bit of this, a little bit of that, and the market can read him what it wants? Or does he kind of go a little more Grinch, at the meeting and sort of say, guys, you guys are wrong by thinking we're going to move this quickly?
I'm glad that there's more than one Grinch then, because they've been calling me a Grinch for days and weeks now since I said that this is a Fed that's going to, through Fed speak, pour some cold water on the markets. They did just that last week. People got mad at me, so now potentially we got another Grinch out there. That's good.
But they did it last week, and the market heard what they wanted to hear anyway.
Exactly. Yeah.
That was kind of it. They gleaned the points in there that were sort of market friendly and ignored the vast majority of it, which was pushing back on this narrative. So again, this is the market. Right now we have a buoyant market. We see it now, I guess, today with consumer sentiment. But the market is buoyant, and it just has this happy note to it. And so why be bothered by inconvenient things like not, do we have the nirvana of rate cuts and a strong economy? I think they're kind of mutually exclusive. But right now, the market wants to believe what it wants to believe. And I will say unequivocally, the news from the economic front today is solid. It's good.
Does the Fed care about the market consistently being in the green, or do they only care if we're in the red? Does the Fed care much about positive buoyancy in the market getting too hot?
I think the stock market thinks the Fed cares about it much more than the Fed actually does.
It's like a bad relationship.
Exactly. It's a dysfunctional relationship, although it is working. It has been working out for markets for the most part over time. The Fed does get worried when market worries can spill into the broader economy. And I do think on the flip side, when they say, if they have to go in there wondering, if they've got room to adjust policy a little bit, and they say, well, markets don't seem to care. Let's do what we're going to do. I think they do worry a lot about fixed income markets, because that's really their bailiwick. Keeping banks. The third leg of the dual mandate is making sure the banking system is stable, and making sure that's their read on how the economy goes. I think they kind of view the stock market as sort of noise, or maybe some sort of backdrop as consumer sentiment. But that's why we don't really see them getting involved unless things really start to spill over in a really negative way that could affect the actual dual mandate.
Well, there's been a lot of noise this morning. I mean, we're taking a look at major averages right now, and even before we went into the employment situation, Prim, we were down fractionally across the board. We've essentially made a pivot in the exact opposite type of strength to the upside now for much of the U.S. major averages here across the board, now seeing the hat trick or the trifecta in the green. As we think going into 2024 and some of the top ideas that you have, what are going to be the sources of hopium that the markets look to, or perhaps your top idea for 2024 even?
My top idea for 2024 is I do think volatility comes back a little bit. I think this idea that we've just sort of abolished volatility is, I think, a little naive. It doesn't go away for any length of time. It does return. And whether that starts next week with some negative comments out of Powell, or just the range of unforeseen circumstances, or the natural volatility that comes with an election cycle, makes me wonder whether, it doesn't make me wonder. I do think volatility makes a comeback at some point.
And what's the trade that initiates then? That
is keeping an eye on VIX, if you trade the VIX products directly, or it means the trade would be, being opportunistic in terms of you can tend to buy options more cheap. It behooves you to buy options when volatilities are low. It behooves you to sell them when they're high. Just like any other financial instrument.
Steve, before we let you go, just one word to describe the type of landing that you think we're going to get heading into 2024.
Bumpy.
Ooh, I like it. Not soft, not hard, just bumpy and choppy.
Exactly.
I love it.
I was on at least one of those flights recently. Steve Sosnick, Interactive Brokers Chief Strategist. Thanks so much for taking the time here
My
today.
pleasure as always.
Absolutely great to see you. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
All right, digging into currencies, the Japanese yen giving back some territory today after its second biggest strengthening move of the year. That's as the Japanese bond market now pricing in a potential rate hike, a turn from the BOJ at that December 19th upcoming meeting. That would shut the door on an 8-year experiment with negative rates. So for more on what this means for investors, we're going to turn to our very own Jared Blickery here with us. Jared, what do you got?
It was a shot across the bow for central banks yesterday, and they need a message here. The Japanese central bank has a meeting in a couple weeks, and this was thought to be a dead meeting, but now it is a live meeting. No sleepy end to December here. I'll get to that in a second. First, want to show you what the yen is doing today. All this green means the yen is strengthening, and so now it is continuing that move off of yesterday. And here's a 2-day look where you can see number one gainer, the Japanese yen against the Swiss franc, up 3.4%. You don't see these kind of big moves often in odd currency pairs like this, or some of the exotic ones, I should say. But this has to do with the interest rate structure. Now, first I want to show you how the bets on this December meeting for the BOJ have been shaping up. This goes back to a few weeks ago, but they just shot up the other day. This came after comments that the governor there, the Bank of Japan governor, is going to be figuring out next year in the January whether or not consumer demand warrants the current interest rate level. You read through all the tea leaves, they have to raise rates. This is the Federal Reserve response. This is the response in the market to the job numbers that we got this morning. Today, 12.8, this purple line, this is pricing in fewer cuts than we were just a few days ago. So this means, this directional move means that fewer cuts are being priced in, and that's not necessarily good news for currency investors, for bond market investors, because the gap between the Japanese yen policy, the Japanese policy rate and the ECB and the United States are just too wide. So a few things can happen. The Japanese yen, the Japanese policy rate can rise, or you can have some of these rates in the Europe and also the United States coming down to meet them. But with a less likely chance that we're going to get rate cuts next year, you would expect some pressure on the markets. But we're not seeing that pass through just yet. I want to stick with the Japanese yen here, so I'm going to go back to our heat map and just show you what's been happening year to date. And you can see a move in the opposite direction. Lots of red and dark red here. The only gainer is yen versus the Argentine peso there. That's a separate story. But this has been a big concern for the Japanese government because they own such a huge percentage of the bond market there. A disorderly unwinding of that policy rate going back, that rate that has to come from negative 0.1, that would spell disaster for risk markets. But again, we're not seeing that spill over just yet. So enjoy the gains off of that better than expected payrolls report today.
Enjoy the gains. That's my motto at the gym every day, Jared. Thanks so much. Appreciate that hit. Also, everyone, we got to take a look at CrowdStrike. November's payrolls report comes in hotter than expected. 199,000 jobs added. Unemployment rate unexpectedly fell, reflecting signs that the labor market isn't cooling as quickly as many had thought. But not all industries are making significant progress in hiring. Demand for cybersecurity jobs, that remains high, and hundreds of thousands of job positions are looking to be filled. For more, we're joined by George Kurtz, CrowdStrike CEO. George, great to be with you here this morning. And I mean, you've had a busy week. My goodness, you were speaking at a few different conferences, all out in San Francisco, both at the Jefferies Cybersecurity Summit as well as Barclays Global Technology Conference out there. Ultimately, net, you think about the global cybersecurity landscape right now and where more jobs, more roles are still needed to be filled to meet the expectations that many of your customers have. What type of kind of delta are we going to need to see in this near term?
Well, great to be here. And it really is a problem in cybersecurity when you think about the job deficit. So many skilled security practitioners are needed, and there's over 3 million open security jobs. So when you think about security and you think about the adversary and how fast they move, it's incumbent on companies like CrowdStrike to be able to arm the people in the field to be able to create that multiplier effect, to be able to actually plug some of these holes. And it's been something that's obviously we've been focusing on extensively, helping our customers. But in terms of the jobs, it's a great field to be in, and B, more people are needed.
More people are needed, particularly when you've got a company that's doing as well as yours. I'm looking at the stock here. Year-to-date returns up 129%. Not a bad year. And when I compare you to some of the competitors across the street, you guys are way outpacing some other cybersecurity names here. But I do want to talk a little bit about those competitors. Zeroing in on Microsoft, how much do you see them as a competitor? Is that sort of a myth on the street, or is that the reality?
Well, Microsoft's certainly a competitor, but when you think about what we're focused on as a company, it's stopping breaches. I mean, that's why I started the company. And the technology that we use is AI native. This is not something that's new to us. We didn't just get into this game. Literally started the company using AI and machine learning at the time to be able to identify and stop these attacks that have never been seen before, and really create the first security platform born in the cloud. It's much differentiated from Microsoft's technology. And in fact, what we hear from customers from a Microsoft perspective, again, using legacy signature-based technology to be able to identify threats is just not going to cut it. So AI is the way forward. And what we hear from customers is their level of transparency just in the pricing alone is causing a lot of consternation. And normally they're getting a big bill and not necessarily getting the outcome that they receive. But again, we've done well because of the platform we've built. It's been embraced by customers. It is, by all accounts, the best in the industry by industry analysts in terms of technology. And we feel really good about where we are today.
What type of propensity to spend further into cybersecurity solutions are you seeing from customers right now?
Well, when you look at things like the SEC breach disclosure, as an example, companies have to be able to identify any incidents. And if it's material, they have to be able to report those within a 4-day period. That starts December 15th. So customers, I think they've got a variety of incentives in front of them. One is SEC, if they're a publicly traded company. Two, probably even the bigger one, is we've seen all the attacks out. You guys have reported on them. These are very determined adversaries in the environment. They move very quickly, whether it's cybercrime or whether it's even nation state actors. And the cost is just too high when you look at even just ransoms. We see ransoms going for starting price of $50 million for a ransom payment. Those can be negotiated down. But at the end of the day, big companies are spending over $100 million if they have a cyber breach. So it's important for them to get ahead of that with companies like CrowdStrike to be able to identify and prevent these breaches before they happen.
You mentioned the SEC requirements to disclose any breaches if you're a public company. I'm curious if that news impacted the length of the contracts that you're seeing. We've seen people kind of paring down the timing of their contracts with cybersecurity companies because of macro pressures. Have you seen any change in that after that news from the SEC?
We haven't seen any change in that. And, again, from our perspective, and we've been very transparent since we started the company, we focus on ARR. That is the key metric for CrowdStrike. And the beauty is we provide that. Many other companies don't. And they have other metrics that they focus on. And when you look at our ARR, it was a record, $223 million. If you look at our growth, over 30% at $3 billion, we're the first security company to hit $3 billion in ARR. And when you look at our performance, I really call it the triple threat. You've got over 30% growth on the top line, over $3 billion, that's at scale. The second piece of that is 30% free cash flow. And the third element is over 20% non-GAAP operating income. We are in rarefied air when you look at those metrics.
Yeah, absolutely. I mean, I'm looking at a lot of the metrics that you just mentioned here as they were reported in your most recent quarter here. When you think most notably going forward about where margins, on top of all of the different services that you already offer, where you're expecting that to continue to trend, what is going to be the catalyst for even more margin growth for the company?
Well, as you continue to scale, as we continue to scale, we become even more efficient. We've done a lot within our own tech stack, obviously, to be able to drive efficiencies. In September at our Falcon conference, our CFO, Bert Podbear, actually moved up our long-term gross margin target operating percentage. So from our standpoint, it's being more efficient, but using things like AI. We use AI throughout the company. That's in our DNA. That's obviously in our technology with things like Charlotte AI and customers are embracing. It's also within the company itself and how we deliver services and how we make things more efficient for our own people. And I think leveraging those sort of technologies internally as well as providing those to our customers is going to help continue to drive gross margin improvement, which really then falls to the bottom line. And you see that in our cash flow generation. Which again at 30% at our scale is quite remarkable. So we always want to get better and we always want to be more efficient. And every day we think about margin and cash, and those are the big drivers for us.
Well, George, one potential driver of efficiencies, very much so, would be artificial general intelligence, the idea of machine learning that makes itself smarter and can accomplish quite a lot of human tasks. Elon Musk recently said that he sees AGI coming in as close as 3 years. What is your take on the timeline to AGI, and how does that impact how you're thinking about leading the company?
You know, it's a great question when we think about AI and just how much has happened in a short period of time. There was obviously a lot going on behind the scenes before ChatGPT went mainstream, right? Which was a bit of a revelation for many folks. We've had a data science team really since I started the company for over a decade now, as many other companies have had. And when we think about the advancement, just how quickly they're moving forward. Certainly a 3-year timeline, I think is in play. But I think what's important for us and for others is to be able to leverage that technology, as I said earlier, not only drive efficiencies within our companies, but to get greater efficiencies from a customer perspective. They're looking for efficiencies. They're looking for cost savings. And one of the things that we really focus on is Charlotte AI, which is really then creating this virtual security analyst. So trying to fill some of the gaps that we talked about earlier. How do you actually create a virtual analyst that has the collective knowledge of CrowdStrike, but then also can do work on behalf of the company? And that's really where we think there's a lot of opportunities, and we continue to help pioneer a lot of the science in this particular space.
Absolutely. Well, thank you so much, George. We really appreciate your time and your insights on all things AI and cybersecurity. That was George Kurtz, CrowdStrike CEO. Really appreciate it. We're going to have all your markets action ahead here on Yahoo Finance. Stay tuned for more.
Welcome back to Yahoo Finance. Well, this year has been a tough year for startups looking to raise money. There's new data out from Crunchbase that shows that early stage funding fell once again in November, down about 34% from a year ago. So here to discuss what the past year has been like and also the state of play for the VC industry, we want to bring in Bilal Zuberi. He's a general partner with Lux Capital. Bilal, it's great to have you here. Thanks so much for taking the time.
Great to be here.
So let's talk about how tough or challenging this past year has been. At Lux Capital, you guys have about $5 billion in assets under management. You're funding, mostly funding science and technology types of companies. So what have you seen some of the trends over the last 12 months?
I mean, look, generally speaking, the last 12 months have been a downer for the industry. There's been fewer financings if you take AI outside a little bit. Lack of IPOs, lack of liquidity for our LPs, and we're very cognizant of that. That has meant a lot of belt tightening for a lot of startups, a lot of changes in operational plans that allowed them to reach profitability sooner. That has meant layoffs, that has meant a lot of change in planning on what the company accomplishes. At the same time, we invest in a few broad areas that we consider to be not only important for society, but also where venture dollars have been flowing in. Things like securing our borders, securing our freedoms, and securing environment. A lot of money has gone into defense tech and continues to go in. We've been beneficiaries of that. We work a lot in increasing productivity of human experience, everything from mobility to the way we do work at home and in our offices. A lot of money has gone into that. AI has been a part of that. We do a lot of investments also in improving human life and condition and reducing human suffering. And there's been a lot of money that's gone into that as well in drug discovery companies and so on. And frankly, there's a little bit of an M&A that's been happening in the last few weeks and months. So we've been watching that very carefully there, some very large ones. And then last but not the least is, unleashing human creativity, where we've invested in companies like Hugging Face and Runway and many others that is really, democratizing access to technology. I mean, there's literally, I can sit online and watch television stations now where you can watch completely AI-generated movies. And so there's a lot of interesting things happening at the same time. But as I was telling the conference here earlier today, it's always good to be here and with public market investors to really calibrate for private markets as well, and to understand all these companies that are now Series A, C, D, E, whatever stage, they're eventually going to be either public company or get bought by public companies. What will be expected off of them? And I think that is there's been a real dose of medicine that private investors have had to take.
And how have those expectations changed?
So I think 2-3 years ago, it was all about top line growth. Everybody was looking for growth and where can you find growth? And that was what the VC was known for. And now people are looking for building real businesses and building profitable businesses. There's this thing called profit that startups can aspire to as well. And I think the reality of it is that, if 2, 3, 4 years ago, startups used to be very narrative driven, they've become very much metrics and operations driven. And I think that has required VCs and founders and CEOs and executive talent that's been hired over the last 2 years to really hone in and understand how do you actually build real businesses.
And do you think that's the case for AI as well? And I just bring that up because there's been so much focus on that, much of it being hype, much of it being more of an excitement rather than a show me, prove me story, at least up until this point. Is it a little bit different when it comes to some of those AI plays?
Yes, look, AI is still or at least generative AI, which is this new wave that we're going through, is still fairly new. The pace of development has been incredible. In fact, every time I look at it, I'm astounded how fast it's moving and how fast it's moving into every facet of our society. Some of the valuations will remain high and will remain perhaps inexplainable. But even in AI, in the first quarter of 2023, the valuations were off the charts. Frankly, didn't make any sense. And I think the reality was everybody was trying to place their bets. I think people have sobered up a little bit, not as much as they probably should, but they have sobered up a little bit to basically say, are we actually using AI to build businesses and solve problems? And to be honest, in some ways, you saw that in the very public drama that happened at OpenAI, right? I mean, the shuffling around that happened was a little bit of, are we a research firm or research-only firm, or are we also a research-only firm that now has shareholders and frankly, even employees that hold equity into the company, and we have to build a business for them.
When it comes to your specific investment criteria, you mentioned some of the companies that you're involved with. When it comes to the AI or those who have exposure to AI, Runway, Hugging Face, just to name a few of those, what is your criteria when you're out there trying to identify that next investment?
So we invest at the intersection of technology and sciences. So we're always looking for where's the cutting edge work happening. So if you look at Hugging Face, it's the cutting edge models developed open source all around the world, made available for everybody to use. Together doing the same thing with enterprise applications in mind and providing the infrastructure to make that happen. Mosaic ML was another company that Databricks acquired in this year, just a few months ago. Same idea, building that. Runway ML is cutting edge on visual, creating videos. But then also again, companies like, we've done some, stuff, large investments that are still in stealth mode around, using AI for drug discovery purposes, right? We've done work around using AI for defense tech purposes and national security and cybersecurity. My last investment, we literally wired the money yesterday, is in AI cybersecurity. If AI is being used by not only every person at home, but every employee in your enterprise, and every app, every SaaS app that you're using is using AI, how do you think about securing the data that and IP that you have from leaking out and securing that? So there's a lot of interesting stack that's getting built up. And I think the beauty of it is why you see a lot of VCs interested in it, is that you could be investing in any space at any stage and you will find an interesting AI application there.
From the discussions that you've had, and Hugging Face is one that I'm thinking of, when you talk about the potential for it to go public, are business leaders, are they a little bit more open to potentially entering the public markets as you look ahead at 2024 and beyond?
I think people are very open to making sure that they are building companies in a way that they could go public. I don't think the public markets are open yet, at least not for a lot of companies. So people are still waiting for the larger companies, the Databricks of the world, the Stripes of the world to go public first. But certainly people are starting to think a lot about, building these companies responsibly, financially responsibly, ethics-wise responsibly, and with global markets, understanding where the regulatory landscapes are that they're going to be playing in. These AI models are being used in every application, right? You're building games with it, you're building dating apps with it, but you're also discovering drugs that are going to go through FDA processes, and you're building, tools of warfare. So you have to be very carefully building that, and I think companies have brought on executives to help them think about revenues and margins and large enterprise contracts. And why you're seeing some of the companies like Hugging Face, Together, and others grow is because they're serving the needs of their customers much more efficiently and effectively.
Bilal Zuberi, great to get some time with you, general partner with Lux Capital. Thanks so much.
Thank you so much. Great meeting you.
Our thanks to Shauna Smith for that fantastic interview. Now turning over to Tesla, turning things around in China. The EV maker seeing vehicle sales rise 5% year over year in November. The uptick comes after 2 straight quarters of declining sales in the country. That's according to data from China's Passenger Car Association via Bloomberg. So what's motivating the upward trend? With us now is Yahoo Finance's Praz Subramanian for more. Praz, what do you got?
Hey, how's it going? So yeah, that's right. 5% jump there in China sales, around to 65,000 units there for the month of November. Compared to a year ago. This, as Tesla is actually raising prices slightly through the month of October and November here. So they're sort of calibrating where they want to be. Little mini hikes for the cars there. Want to note something though. Total deliveries from Shanghai, from Giga Shanghai, were 82,000, and that's an 18% drop from a year ago. And that's because that's a lot of the front loading of the exports. And so in November and October, so in November, most of it is going to be China actually domestic sales. So that's what that number is this month. That's why it's up, but the overall number is down. And that 5% raise in deliveries is good news for Tesla in China, because that is a very hyper-competitive market with the BYDs and companies like that. They're eating away at their market share.
This is a company that just came off its Cybertruck event. I mean, region by region, is it clear yet how many people are actually going to take delivery of this vehicle?
The Cybertruck?
Yeah.
It's only U.S. for now.
Okay.
And then probably...
Well, that narrows it down then.
And then eventually Canada. I think eventually Canada.
Yeah.
And then we'll see. Maybe they will be an international response. I mean, I'm sure look at the Google search interest, right? It's insane in terms of I saw a graphic about F-150 Lightning, Rivian, and Tesla Cybertruck Google search across the United States, and it's almost every state is Cybertruck.
Wow.
A couple Rivian states. So it goes to show you, there is interest, maybe good or bad, but the people are interested nonetheless.
All right.
Very interesting. Do we have time for one more question quickly for
go for it.
Praz? Okay, well, as I ask out loud to our producers, I'm just curious.
We have time. Yeah.
Thank you. I know, Brad, your mom just got a Tesla, is that right?
Oh, no. Well,
a family member?
Still has the, I believe, Model 3.
Okay.
And they just recently checked out the Cybertruck. I believe they drove across state lines to go see.
Oh, wow. Okay. So that is an example. And my mom recently told me she wants to get a Tesla now so that by the time she's aging, she doesn't have to worry about not understanding how an EV works when she switches. Is that a growing market for the EV space? Is there potential that that could be an untapped demographic, some of the older individuals who might be able to become new customers for Tesla?
Yeah, I think so. I mean, look, we're only approaching 10% market share for overall sales this year, right? We're not there yet. We're approaching it. So there's 90% of people that are car buyers that are interested or potentially could be your market for EVs. And a lot of those buyers are like people like your mom, or I mean, Brad's mom's an early adopter, right? She drove across state lines to see this Cybertruck.
My parents are way cooler than me.
Yeah. So I think there's a definitely mix. My parents are interested in EVs and they don't have one yet. So I think there's a huge potential market there. The demand may be slow to come by potentially as we see prices come down. That could help. But I just read a report today about how the residual values on EVs are really bad, and that's hurting interest. So if are you gonna want to buy an EV if you know that it's going to be worth half as much in 3 years, whereas a gas car might be worth 3/4. So I think that's sort of the problem there is how do you address that residual value market? And your mom might be like, hey, you know what? Maybe I'll stay with my Prius or something like that.
I'll have her email you some questions, Praz. I'm sure you'll love that.
Waiting for the network to grow out right now, too. Praz Subramanian, thanks so much. Appreciate it. Oh, your market action straight ahead, everyone. We've got much more here on Yahoo Finance. Well, we've had a number of our guests over the past week sharing their views on what areas to keep an eye on ahead of today's jobs report. Here's a roundup for you.
If you look back last month, we saw manufacturing had a notable decline. That should be added back in. You also have the Screen Actors Guild strike that ended. So those will indeed be added back in. However, it's worth noting in terms of the unemployment rate, those workers are not counted as unemployed in the eyes of the household survey. So that will have no impact on the unemployment rate. Wage growth has been slowing, and one sector in particular I've been pointing to is the information sector, particularly within tech. So there we know we saw notable layoffs throughout 2022. And if you looked at the past report, their wage growth on a year-over-year basis was well below 2%.
Certainly starting to show some weakness, but it's showing some weakness from some extraordinarily tight and extraordinarily strong levels. Last month's jobs report was one where I do think that you're beginning to see some of the weakness broaden out. You saw the unemployment rate rise to 3.9%. We saw the diffusion index, so how broad-based our job gains really begin to decline. You saw permanent job losers rise. And so all these, I think, are evidence that the labor market is very clearly slowing. I think it's critical whether or not we get continuing evidence of that over this next week. The JOLTS report tomorrow is really important. Obviously, Friday's jobs report is important. And then over the next several months, the labor market, from my perspective, is in this really critical juncture. If it stabilizes near these current levels, then you get a soft landing that everybody is very hopeful about and that the market's increasingly priced. But the second derivative on these moves is pretty negative. And if you continue to get a softening and weakness, then I think the market begins to get concerned about these somewhat worse mild recession type dynamics.
The ingredients that are likely part of the recipe to not just stay in pause mode, which is justified, but actually pivot to rate cuts wouldn't so much be a recession declaration. They know that's a lag in terms of the official nature of it, but to have both of their dual mandates sort of sending the right message. So inflation continuing to come down to, or at least closer to, their target in conjunction with more loosening in the labor market. They don't want to see a labor market that collapses, but they want to see a loosening. They want to see some more easing wage pressures. And I think once you have the combination of those two, then I think the Fed might start to telegraph easier policy. But probably the thought right now is stay in pause mode and assess the so-called long and variable lags.
The consumer is significantly overextended in how much they're spending. The savings rate hovering just around 3%. And I think that businesses so far have been happy to maintain relatively high employment because of that spending. But once one of those legs starts to wobble, I think that that's the beginning of the end for this labor market cycle. So if the Fed is looking at some lagged data, they'll be thinking that they're still on this glide path towards the golden path or whatever they've been talking about at the end of Q1. But I think by the time we get into May and those subsequent meetings that you referenced, by then they'll be chasing a labor market that's weakening more rapidly.
So one of the things that I think about with this, especially coming off the print that we got today, which not only defied expectations on the headline print, 199,000 jobs added versus the 180-ish that were expected coming into this report, 185K to be exact there, and then an unemployment rate that actually ticked lower when it was expected to stay the same month over month at 3.9%, and no change in average hourly earnings. The thing that I think about is this employment situation and ultimately this labor market seems like the case of the Weebles wobble, but they don't fall down at the end of the day. We saw and we have seen wobbling in the form of a trend where the Fed was looking for more of the continued decline, perhaps in that headline print, moving lower, and then additionally, ultimately, continuing to try to see where the unemployment rate might need to tick higher at the same time in order for them to say, okay, now we see reason for us to shift our narrative or shift our tone at least. This defied that in entirety almost today here. So it's a larger question of, do we see more prints like this that defy the expectations and thus changing the calculus for the Fed, making them more aggressive? Or do we see a reversion back to what we saw last month where you saw a miss on that headline print, a move higher in the unemployment rate, and then a Fed saying, okay, we're back on track to where we were at sitting on our hands and higher for longer type of narrative?
Well, we're already seeing the market kind of suss out whether or not the Fed is going to cut as much as we had priced in earlier this morning. We were pricing in 5 rate cuts next year before that jobs report. That's already been undone here. And you can see that movement in the bond market in particular. And when Steve Sosnick was on with us, he said something really interesting. He said he described the landing as a bumpy landing. And he said that if you were priced for those 5 cuts in your portfolio next year, you're going to want to put that movement and unwinding of that price action into your bond holdings. So I thought that was a really interesting look, particularly in the short-term bond space. And we did see that movement in the market today. today, which mirrored some of the calls that we got from big banks coming out of Bank of America earlier today as well, Brad.
Yeah, Sosnick saying that these numbers today do not signal a recession, so it'll be interesting to see where the commentary continues to come forward, and perhaps mirroring that of what Steve Sosnick told us here on the show earlier.
Yeah, if it is a recession, it's a very, very happy one when it comes to the labor market. We're going to move on and switch gears, going a little bit more global, because earlier this week, Venezuela's Nicolas Maduro called for seizing a part of Guyana. Guyana is a small bordering country about the size of Kansas, got a population of about 800,000 people, but the global impact here could be bigger than what a lot of folks are thinking. We've got Yahoo Finance's Rick Newman here to help us understand why this could be very important, not only in the region, but also to the U.S. Rick, thank you so much for coming on. Talk to me about what's going on in this region when it comes to the oil picture. What do folks need to know who aren't familiar with this story?
Yeah, a lot of people have never heard of Guyana, and if they have, they probably don't know that it's actually becoming a significant oil producer. These days, I notice anything that could affect global oil supplies, either positively or negatively. So when Maduro in Venezuela said, we're going to claim 2/3 of Guyana as our own, and that would include these oil fields, I perked up, because the Biden administration has been basically scouring the globe, trying to figure out where it can get just a little bit of additional oil supply going into 2024. Including Venezuela. The Biden administration actually eased restrictions on Venezuela in October. They didn't come out and say why they did that, but I think it's pretty clear that they were hoping there could be a little more oil production out of Venezuela. And they are just trying to get, even if it's just a couple 100,000 barrels of additional oil onto the market, they'll take it, because Biden, obviously scarred by gasoline prices in the United States that hit $5 a gallon in 2022. His popularity rating plummeted along with that, and it has not come back up. So the Biden White House clearly knows it has to keep gas prices down. So to go back to Guyana, Venezuela says, we think we're just going to take over these oil fields. Now, that analysts don't think that means Venezuela is going to invade Guyana. It could, but it sounds like it's kind of just like a shakedown, like Maduro in Venezuela. He's looking at what Vladimir Putin did in Ukraine, surprised everybody, invaded, and got the world's attention. So it's kind of like he wants a little bit of a payoff from Guyana. So we had just this week, the Secretary of State, Antony Blinken, had a phone call with the president of Guyana, said we support Guyana. The Pentagon has said they're going to conduct military exercises with the tiny military force in Guyana. So I'm calling this another energy skirmish that we probably need to be paying attention to.
Yeah, well, and you make the great point that as we head into this election, the relationship with the U.S. is going to be ever more critical. I'm curious, when it comes to Venezuela versus the U.S. and this story, which do you anticipate having the bigger footprint on the oil coming out of this region as we head into 2024?
I mean, Venezuela is a train wreck of a country. We've had these corrupt and disastrous socialist regimes with Maduro and Hugo Chavez before him. Venezuela is actually really important to the United States for a couple of reasons. Little Guyana to its south has like 1% of the oil reserves of Venezuela, and yet it is probably going to be producing more oil in Venezuela in just a couple of years, because Venezuela's oil infrastructure is just so wrecked. Venezuela also a significant source of migrants to the United States that is causing President Biden so much trouble politically. A lot of those migrants come from Venezuela, and that was another thing Biden tried to do with easing the October sanctions, was to get more people to stay in Venezuela instead of coming to the United States. So Venezuela is a multifaceted problem for the United States. I mean, it's kind of funny that Republicans say, whenever they say the Democrats are taking a socialist turn, they're going to turn us into Venezuela. But we have all these people in Venezuela who want to escape socialism and come to the United States. And we've got a lot of people saying, no, don't let them in. So, of all the problems in the world, and there are a lot of them, Venezuela is popping up as another one.
All right, Rick, thanks so much for continuing to keep tabs on this and breaking this down for us this morning. Yahoo Finance's own Rick Newman. Great to see you.
Bye, guys.
Thank you. We're keeping our eye on another big mover this morning. Paramount Global shares jumping over 10% to the highest level seen since July. It comes as a deadline report suggests David Ellison and Redbird Capital have expressed interest in the group here. You're seeing shares higher by about 12% as of right now. And one of the huge things around this is really the holdings that Sherry Redstone has at Paramount, and that potentially being up for sale at the right price here. Now, the larger question and what's been brought up within this is Skydance Media kicking the tires, as the report says, on Paramount's assets. Puck News' Matthew Belloni, reporting that.
Yeah, I'm looking at the Paramount stock, and at least the last time my terminal loaded for me, it was the best performer of the S&P on the day today off of this news. And it really just goes to show some of the broader interest in this space. Volume up for the day here as well, which is leading to more of that trend when it comes to pushing up this stock. In the past couple of weeks, there was another signal with Paramount going over its Bollinger Band. Trading in the company's bonds was also really high. So some of those more technical indicators that are obviously not directly related to the news today, but all spelling good news for the stock.
Yeah, absolutely. About 78% institutional ownership for this name. So that's something to continue to keep tabs on as well here. Everyone, that's all for us today. Rochelle Akufo has much more at the start of the 11 a.m. hour.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here are our top stories this morning. November's payrolls report coming in hotter than expected at 199,000 jobs added. The unemployment rate unexpectedly fell, reflecting signs that the labor market isn't cooling as quickly as thought. And the UK's watchdog on the hunt. Regulators in Britain taking a closer look at Microsoft's partnership with OpenAI. The tech giant recently given a non-voting board seat at the startup. Officials investigating whether the investment has more or less amounted to a merger. And Micron strikes a union deal for $15 billion chip plant. It should give the semiconductor giant a helping hand in receiving those all-important government subsidies. We get into that story this hour. But first, let's take a look at how major indices are faring. Looking at relative gains across the board here after we saw that jobs number give the markets a bit of a wobble, wondering if they had perhaps jumped the gun on expecting those Fed rate cuts next year. But currently looking at the Dow, up about 1/3%, or 124 points. The S&P 500 also up about 1/3%. Tech-heavy Nasdaq, the strongest gainer so far this morning, up about 60 points, or 0.4%. Let's also check in on how those moves affected the Treasury market. Looking at the shortest term here, jumping more than 3% on the day, about 3.3%. Looking at the 10-year, also solidly up around 2008 highs, standing at 424. And looking at the longest 30-year, that's up almost 2% on the day. Well, today, UK competition regulators are reviewing Microsoft's relationship with OpenAI. The watchdog probing if the tech giant's $10 billion investment resulted in a merger-like situation. Now, this comes a week after the ChatGPT creator saying Microsoft will have a non-voting board seat. Now, Microsoft is no stranger to scrutiny from its UK antitrust regulators. This is the second probe for the company this year. So how will this review impact Microsoft? Well, for more on this, Rohit Kulkarni, Roth Capital Partners Managing Director, is here. Thank you for joining us this morning. So what do you make of this? Essentially, the CMA saying this is an acquisition of control here. Do you think this amounts to that? Was that perhaps that non-voting board seat the tipping point?
Yeah. Thanks for having me. I think that's exactly the key point here. The non-voting board seat, or board observer seat, as they say. It's a very small board, just 3 people here. And Microsoft did not have anything to say with the board about 10 days back, and now they are slowly inching into the board. They already own 49% of the for-profit arm of OpenAI. So there are building blocks coming together for a potential acquisition if there is a fallout between the non-profit and for-profit parts of OpenAI. So it's right to take a closer look at this, given the power that OpenAI has and given the power that Microsoft has with its distribution, that creates a high concentration of power of AI, and given what AI means for tech over the next 5 years.
And we know that the EU has been leading the charge when it comes to trying to get some sort of framework for AI regulation here. Do you think the US is likely to follow that lead, as they also are having a lot of issues when they're looking at some of these antitrust regulations?
Yeah, absolutely. I think the UK regulators, the CMA folks in the UK have always been on the bleeding edge of new tech regulations, given the asymmetric kind of power that big tech has in Europe, and all of them are American companies. So they tend to move a little bit faster. But what we were also surprised by was that not too far back, Biden administration also put out a very lengthy kind of mandate, or almost kind of best practices as to what they think AI regulation would look like. So think about, within a matter of 6 months, they met with a lot of industry experts, and Biden administration was able to put together this AI package in front of all the big tech companies. And now that conversation has already started. This is a very new technology with a lot of unknowns and more black box behavior, more control with companies with larger data and larger resources. So I think the surprise factor is US is following up, but following up not too far behind.
And it's interesting because you have the companies themselves trying to make their own rules of the road. You have OpenAI and Microsoft, and then you have the separate alliance that we saw now also coming with IBM and Meta as well. How much do you think regulators are going to perhaps lean on the tech companies to essentially self-regulate and set these rules of the road versus having to take their own route?
In my opinion, given the velocity with which AI tech and AI innovation is moving, I think it behooves on self-regulation on these companies. Again, it's very hard when it comes to a business use case versus a long-term ethical use case. It's going to be blurry in the next, call it 12 to 18 months, whether these companies can self-regulate. In the meanwhile, the executive order from Biden administration was very encouraging. I think one would have expected something like that to happen in 2024 or maybe 2025 even, but seeing that even before the first anniversary of ChatGPT, that's an encouraging sign. So probably we are going to get more regulations with regards to maybe compliance, with regards to disclosure, with regards to transparency, and then that would be a step towards control and how much power some of these big tech companies will continue to have.
And what do you think this is going to mean in terms of the corporate structure of OpenAI? Obviously, it has its non-profit arm, but then you have Microsoft owning 49% of the for-profit aspect of that company. What are we expecting to happen in terms of corporate structure that could perhaps call for regulators or perhaps draw their ire further?
It is a big mystery, in my opinion, Rachel. In my opinion, what unraveled in the last 3 weeks at OpenAI is still an undisclosed mystery, probably one of the Silicon Valley mysteries that we would never find out. But that does kind of put a greater kind of spotlight into governance and in the future of what the for-profit arm of OpenAI could look like. Again, clearly, a lot is at stake here, not just the economic value of OpenAI, but the control of the narrative of who is an AI leader going forward. And right now, Microsoft has clearly won that narrative versus other big tech companies. So I think a lot is at stake here. How that unfolds is anybody's guess. But given a lot is at stake, I think Microsoft wouldn't be willing to give away control in anytime in the near future, is my thinking.
Indeed, we'll all be watching closely. Appreciate you joining us this morning. Rohit Kulkarni, Roth Capital Partners Managing Director. Thank you so much. Have a good weekend.
Thank you.
Well, another win for Labour. Micron is striking a union deal for the construction of its Boise, Idaho chip plant. Now, this comes as the Commerce Department is set to announce the first awards of the $100 billion worth of subsidies from the CHIPS Act by the end of the year. Now, the Biden administration has expressed a strong preference for applicants that have reached construction accords with unions. For more on this, we have our very own Jennifer Schonberger and Rick Newman. Welcome to you both. So, Jennifer, you spoke to Acting Labour Secretary Julie Su today. What thoughts did she have on this union deal?
Hey there, Rochelle. Boosting union workers is a big part of President Biden's overall economic strategy and boosting the labor force. And you're seeing evidence that that strategy is working in Micron's deal that was just struck for a $15 billion chip facility, 37,000 workers, the majority of which will be union workers. I spoke with Acting Labor Secretary Julie Su last hour, who emphasized the power of the bargaining table for higher wages and better retirement benefits.
This is a moment in which there's broad support for unions, both from workers and also from the public. And so companies are seeing the benefits too. So Micron entered into an agreement where they're going to use a project labor agreement for its construction. That means that there will be construction workers who are paid good union wages, who are, have the security and stability that comes with that kind of job.
Sue told me that next year she expects union jobs to increase, driven in part by the federal government's policies, including the CHIPS Act. But she also pointed to non-union workers who are seeing success from unions driving up wages. And we saw evidence of that this week with workers at Volkswagen's Tennessee plant who are now voting to organize under the UAW.
And so, Rick, I want to bring you in here as well. I mean, obviously, we know President Biden, very pro-union. We saw that sort of split between some in the Republican Party when he was stomping on the road for the UAW. What does this mean in terms of what we should expect politically, perhaps some of the blowback, or how this is being received?
I mean, Biden has campaigned and presided as he calls himself the most pro-union president ever. And I mean, I'll say that's plausible. Say he can claim that. So Biden took a risk earlier this year when he joined the UAW workers on the picket line. That was unprecedented. The president has never done that. And I think that risk paid off for Biden because the UAW ended up getting a good deal. And then we saw these increases in wages for non-unionized auto workers at places in the South and so on. So I think Biden can claim victory on this. Now, the big question with Biden is all the things he says are working in the economy and that he claims credit for, voters just don't give him credit for it. So the question really is, will this sort of thing move the needle? We're talking about the construction of a factory here, which would be about 3,700 construction workers. So they would help, those would be unionized workers mostly. They would help build the factory, but they would not be the people working at the factory afterward. And I would just point out, Taiwan Semiconductor is building a plant in Arizona, perhaps also getting some of those subsidies. This doesn't always go smoothly. They've had trouble getting workers to get that plant completed, and that is kind of falling behind schedule. So I think the headline for Biden is a win, but the continual problem he faces is getting credit for his wins from voters.
And you raise a good point. There is this apathy. I mean, he's always touting, unemployment being under 4% for, I believe, 22 months now. Still seems to be falling on deaf ears, at least in terms of how people feel. So, Jennifer, when you look at the economic impact, sort of what this is touting versus what people are expecting here, what's some of the things that you're hearing from lawmakers?
Yeah, I mean, when it comes to unions, Rochelle, I mean, this is obviously going to help, right? The administration thinking that union jobs will increase over the next year. And we are seeing some small uptick as there is interest. But union jobs are still a very small percentage of the overall labor market. And so I don't think it will move the needle that much, especially as we're continuing to see a slowdown in private sector jobs. You looked at the job report today, and the bulk of it is actually being driven by government, by state and local government specifically. The other side of that was healthcare, which is basically just a replenishment of what we saw from the pandemic. So we'll have to see how this plays out. In speaking with Secretary Sue last hour, she was, of course, very bullish. She mentioned that when I tried to ask her next year, no recession, she wouldn't call a prediction, but said that month after month, this administration keeps surprising to the upside. Certainly the consumer is still hanging in there, still strong, but cooling from what we saw back in September. And I think a lot of that is going to hinge on the job market. Whether unions, though, will be the linchpin, I think that remains to be seen. And I think that will be a heavy lift over the next year.
And Rick, Jennifer raises a good point. Given the small portion of the workforce that unions make up, then what is the strategy then in really sort of for some of these companies to put unions first as a way to sort of get some of this CHIPS Act money? Could they perhaps risk, damaging their bottom lines here by hitching their wagons to unions?
Well, I think Biden is going to get a lot of endorsements from unions. I mean, he did in 2020, and I think he's going to get a more full-throated endorsement from the UAW as one example in 2024. Let's keep in mind that the winner of the 2024 presidential election is going to be determined by a relatively small number of voters in probably only 4 or 5 or 6 swing states. And that does include Michigan, where a lot of those auto workers are based, and Wisconsin, where there are also some auto factories. So could Biden get a little bit more of the union vote in Michigan and Wisconsin that he would need to win in 24? I think it's plausible. I mean, we're talking about less than 1% of the vote that will determine either the Republican or the Democrat in those 5 or 6 swing states. So, yes, I mean, that is one instance where it could move the needle for Biden politically. It certainly is not going to hurt him. I mean, he's got momentum in the upper Midwest because of his endorsement of unions and the actual wins unions have gotten here. As for these other plants, we're talking about one in Idaho. That's a Broadcom plant. That is a Republican state. Biden's not going to win that. There's another one in New York. That's a Democratic state. Biden will. That's not up for grabs. Arizona, though, is one of those swing states, and that is where this TSMC factory is underway that could also get some benefit from the CHIPS Act. So watch that.
Certainly we'll be watching that space. Appreciate both of you, Jennifer Schonberger and Rick Newman. Thanks so much.
See ya.
Well, of course, the jobs numbers came out this morning, with the US adding 199,000 jobs and unemployment data unexpectedly falling. Let's bring in Yahoo Finance's Josh Schaefer to discuss what this might mean for the Fed. Hey, Josh.
Hey, Rochelle. Yeah, so I got this nice big graph here of non-farm payrolls, monthly additions, going back a couple of years, but really what I want to, or going back a little bit over a year, but what I want to focus on is just the trend that you can see here, right? So we had 199,000 today. Overall, we're just coming down, right? And I think that's sort of what people are looking at here. You're seeing the overall labor market slow down a little bit, but we're still growing. That's important to think about. We're going to get back to that in a second. I want to also hit on the unemployment rate, coming in at 3.7% for the month of November, down from 3.9% unexpectedly. And that sort of builds this narrative, well, if unemployment's coming down and people are still getting jobs, maybe the labor market is in a little bit more of a stable place than people had thought. It's a little tough to see here, but the unemployment rate had been ticking up a little bit over the last couple months. So to see that come down in November, a welcome sign in general just for consumers and possibly investors. Now, a final thing I want to look at here is the Fed projections. This is a projection for a rate cut in March, a 25 basis point rate cut. This is what it was a month ago. Then we had a lot of Fed commentary, a lot of people thinking, okay, we might be in soft landing territory here, jacked up to 55% as of yesterday. So markets were betting that we were going to see that first Fed rate cut in March. At one point, people had thought that might come in June, maybe later in the year. Now, what this labor market data did today, it ticked it down a little bit for us because those two charts I just showed you showed a labor market that's relatively steady, right? It's cooling, but it's still growing. So people are wondering, will the Fed read this as maybe a little bit too hot and maybe it's not time to cut? Now, I think overall, though, how some economists are sort of reading this is basically it's a good thing if these get pushed back, if this 55% keeps coming down, because maybe 55% might have been overdone. We had some strategists telling us that this week, that you're not going to see a cut in March unless you get a recession. And right now, that labor market data really isn't showing us recession. A final thing I want to hit on here is just take a look quick at the S&P 500 and some of the movement we've seen today. And if I can find it, looks like we're about flat now, and we just turned a little bit negative. But one thing, Rochelle, I wanted to highlight, when we talk soft landing, we're talking inflation coming down to that 2% target and not going into a full economic slowdown, right? People are staying employed. People still have money. People still have jobs. And I think that narrative we saw spike a little bit at 10 a.m. today. We got inflation expectations coming down, inflation expectations reaching their lowest level in 2 years. So consumers are starting to feel a little bit more confident in the overall economy and saying, okay, inflation's coming down, the job market is still doing well, I'm overall in a good position. So right now we might have a little bit of that soft landing playing out. Of course, we know, long way to go until we eventually get it, but it seems like that narrative is something that's playing out in the market today.
It's true. We certainly got a bit of an Uno reverse card after the ADP and JOLTS data, and everyone thought they had it pegged. But as you mentioned there, you know, this one bit of data today certainly at least cooling some of those expectations for what we'll see with rate cuts next year. Appreciate our very own Josh Schaefer. All right, stay with us. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Stocks volatile but higher this morning after initially dipping as the hot payrolls report complicates the labor market story. We got JOLTS data earlier in the week that suggested the market may be decelerating. This morning's report showing unemployment has ticked down and that wage growth number remaining high. I want to bring in Matt Miskin, John Hancock Investment Management Co-Chief Investment Strategist. So Matt, as you're trying to make sense of the numbers that we're seeing here, how does this bode for markets?
I think right now it's not as soft of a landing as it was earlier today. It's amazing how widely interpreted this soft landing scenario is. But what we're seeing is the jobs market has been the foundation of the U.S. economy, the strongest pillar, and it continues to be so. It just feels like a never-ending late cycle environment where the economy continues to push along here from the employment picture. But what you saw over the course of the day is the dollar has actually strengthened a bit. The 10-year Treasury yield has risen, and the 2-year yield has also risen, as you touched on earlier. And so that's actually placing a bit less of a rate cut / pivot party types push in the markets right now. So some of those early gains were faded, but in our view, right now, it doesn't really change much. We think the Fed is going to be on hold. We think the market's going to be choppy here after a huge run. And for now, we're just being patient.
Indeed. I mean, it looks like the Fed can afford to at least let the medicine continue to take hold as it works its way through the real economy. But even as we look at year-to-date performance for the S&P 500 and the Nasdaq, still up 20% and 37% respectively. But you say it's not about the sort of the earnings boost, because the earnings growth story didn't really seem to happen this quarter.
Yeah, what we're seeing is a lot of multiple expansion. So the forward PE on the S&P 500 was about 16 to 17 times. We're now more at 18 to 19 times. At the beginning of the year, there were a lot of bears and everyone was predicting a recession. Now there's a lot of bulls and there's very little recession calls. So we've seen a pretty significant sentiment shift. To us, sentiment is a very difficult thing to actually position for. If you want to be a contrarian and be bullish when everyone's bearish, you would have actually done well this year. But now the question is, now that everyone's bullish, are you peeling back some of that risk? In our view, we want to focus on the fundamentals. We're overweight quality on the equity market. We're overweight the U.S., but we are looking to trim some risk here after such a huge run in November.
And so then, is the next story going to be about small caps versus the Magnificent Seven as we head into 2024?
It's just the whole destiny of the market is really driven from those Mag 7, the top stocks. And we do think that's going to make it harder into next year. Tech is up 50% this year. Going into next year, it's going to be hard to replicate that. And it's the biggest sector, almost 30% of the S&P. We do think there is going to be a rotation on a relative basis. But at top level, it's just going to be hard to get much more return potential after such a massive remove in some of these top stocks. So we are positioning for cheaper valuation stocks down in cap, but we got to make sure they're profitable. There's about 40 to 50% of the small cap space that's not profitable. If it's profitable, trading a decent valuation, that sounds like a good opportunity for us on a relative basis into 2024.
And then as we look at the expectations, obviously some of the wind coming out of the sails on either the pace or the depth of the rate cuts potentially that at least markets were expecting. In your note, you say stocks are stories, bonds are math. Walk us through that.
Yeah, so I mean, the stock market this year, again, a lot of it's just a sentiment shift from bearish to bullish and multiple expansion. And a lot of it's the AI trade. I mean, you take out the AI kind of market performance this year, which is a lot of it based on future growth that may or may not materialize. I think this market is it's more like a 10% return instead of 20% return. The bond market is math, and what we do have is higher yields than when we started the year. We're looking at high quality bond yields between 5 to 6% to us mathematically, and they're trading at a discount about 90 cents on the dollar in terms of where they're trading relative to par. That math looks a little more attractive to us than the equity market trading at a high multiple, looking for our high earnings estimates. But we're going to have to see into next year. We think actually bonds can be really competitive for stocks in 2024.
It's certainly a theme that we continue to see. Appreciate you taking the time to join us this morning. Matt Miskin, John Hancock Investment Management Co-Chief Investment Strategist. Thank you so much.
Thank you.
Well, Stellantis and Ample have just announced their new battery swapping partnership that is set to roll out in Europe in the coming year. According to Global Market Insights, the battery swapping market is set to expand, valued at around $15 billion in 2032. But battery swapping still has a lot of ground to cover to catch up with charging stations. Let's bring in Ample co-founder John D'Souza to discuss competing in the EV space. Welcome to the show. So, for people who aren't familiar with the battery swapping technology, I know that it's quite prevalent in China and also as we're starting to see it in Europe, but what are we seeing in the US at the moment?
Well, battery swapping, just from the way it works, is similar to a gas station for electric cars. You drive in, you spend 5 minutes, the empty batteries are taken out and new batteries are put in. So it's a very quick, simple experience. So from an experience perspective, it's something that people are very familiar with. There's a lot of it happening in China, as you say. They deliver a tremendous amount of their energy through battery swapping. Right now, we in the US and in Europe, we're the forefront in terms of going through and doing it. There have been attempts at doing it, but I think what we've really done that differentiates this is the ability to work with different size vehicles. It can be small city cars, big delivery trucks, as well as a full range of different types of vehicles without asking the partner, Stellantis, to make any changes to the vehicle.
So talk about that, because some people have been wondering, depending on the type of battery you have, the type of vehicle that you have, in terms of wide-scale adoption for something like this. So why start with Stellantis, and what tone might that set as you look at perhaps other vehicles and partners to partner with?
Stellantis fits really well for a few things. One is they have an incredible range of vehicles. They go all the way from city cars, delivery vans, delivery trucks. So they cover the range of what customers want. The second is they have a global footprint. The move to electric is in Europe, US, Asia, across all of it. And last is you want a partner that has a lot of experience working with electric, and they've been working electric for a long time. So we're going with them. We're starting off with a car I love, the Fiat 500e. It's a beautiful car, and it's a city car. A lot of people living in cities don't have access to overnight charging. They don't have garages. They don't have places to park. So it's a great option for them to say, you can go through and drive it, and whenever you need energy, stop for a few minutes. We'll expand that range as we look at different segments, going all the way to from passenger cars to delivery.
And when people think about the costs, obviously at the moment, most people still know either the plug-in that you could do at home, as you mentioned there, but that requires, you have to have a home with a garage or a driveway or something, versus, then having to wait at a public charging station. Talk about the cost, though, of EV charging at a traditional station versus going through the battery swap.
Actually, it's a really good one, because a lot of people tell me, if I have a brand new battery in my car, I don't want to swap it out. But the model is slightly different. You actually don't buy that battery anymore. So you actually buy the car less the cost of the battery. So you're paying less for the battery up front, and then you pay a small monthly battery subscription. So you're not buying this battery. So you drive in, you're paying a battery subscription, and then you pay a cost for the energy similarly you do for electricity or for gas. Overall costs, it ends up being very good. You're not taking on the costs of the battery. And so it ends up being very attractive to the customer to switch to this.
And what about infrastructure costs? Because that's not something that we haven't seen a lot of these charging stations, at least compared to what we see with some of these the public charging traditional EV sort of stations there. What sort of costs to meet the sort of needs that you would like? What sort of costs are involved there?
So we actually, similar to a gas station, we provide the stations. So Ample goes through, actually takes on the cost of providing the stations, going through and deploying it. Now, the good news is for us is that we can deploy these stations in 3 days. We need a couple of parking spots and we can go through deploy it. So you can deploy it quickly and cost effectively. So the customer, if it's a fleet, they don't need to go in and purchase it, and we can go deploy it across the city. We looked at a lot of city deployments, and often in cities, it's hard to go through and get a lot of power for a fast charger. So often you find lower power chargers in cities. With this, what you can do is you can keep on charging it, and you can charge it from renewable energy. You have solar, you have other types of renewable. You can keep on charging the batteries in the station, and then when the car comes up, deliver the energy very quickly. You need a super high fast charger to do that, but because you've charged it slowly over the day, you can deliver the energy to the vehicle very quickly. So the combination of bringing in renewable and then providing it to transportation makes it very attractive.
And so when you think of adoption here, because a lot of people would prefer a hybrid because they do have that range anxiety, they don't want to be, stuck on the side of the road here. How do you ease that? Because a lot of people see traditional EV charging as the reason they're not going down that route. But where is the competition then? Is it with traditional EV chargers or hybrids? Where do you see it?
So I think there's a very good use case with traditional charging, and that's especially for people who can charge at home and then don't drive that far during the day. It works really well. You never end up going to a charging station or any of it, and you just charge at home. But if you're outside that use case and you don't have access to it at home or you need to charge it around, this works really well for it because it gives you fast access to energy. And a lot of people talk about range anxiety. I think then people have charging anxiety. What is it that happens when you run out of charge? And you don't want a bad experience. You don't want to spend a tremendous of time. So if you go through and make that experience simple, then I think you would take away the major barrier that people have to owning an EV, which is, if I run out of charge, what am I going to do? And so our goal is, when you go into a city, deploy stations across the city so people have easy access, and then you take away that anxiety that they have.
I'll certainly be keeping an eye on that rollout. Appreciate you joining us this morning. Ample co-founder John D'Souza. Thank you so much.
Thank you very much.
All right, we've got all your markets action still ahead. Stay tuned. You're watching Yahoo Finance. Time for today's chart of the day. Now, it's a very different story for the world's two largest economies. Expectations for economic growth between the US and China are increasingly diverging, illustrated by Apollo chief economic Torsten Slok. China's economy has fallen short of expectations this year, weighed down by a weak post-pandemic opening, real estate market woes, and high youth unemployment. Economists have pared back their growth expectations for the country since this summer. On the other hand, it's been a robust 2023 for the US. Third quarter GDP grew at its fastest clip since 2021, and estimates for the economy's full-year growth have more than quadrupled since the year began. Now, the diverging path suggesting that the two economies may not be as closely tied as they once were. Well, staying with that, looking at Chinese stocks under pressure today. Now, that's in spite of a robust government bond auction overnight and a pledge by China's rulemaking body to, quote, use progress to support stability. For more on what this means for investors, we welcome back Yahoo Finance's Jared Blickery. Hey, Jared.
Hey, Rochelle, use progress to ensure stability. That can mean a lot of things, but not having a whole lot of effect on the market right now. Chinese stocks, we'll get to them just underwater a bit, but I wanted to further expand on China's GDP. This goes back to the early 90s, and you can see how volatile it's been over the pandemic, but it looks like it's right around 4.9, just shy of 5%, which was kind of a ceiling as GDP was very slowly slowing into 2019, 2020. Regarding that meeting, they didn't set the official price GDP target at 5%. That's expected to be done in a few weeks, but the hints are there, and it's expected to be done. The Chinese government, it's no surprise, has been in quite a pickle. It is trying to revive growth after the pandemic, but it's also facing a huge property slowdown. Meanwhile, they don't want to overstimulate. They don't want to print too much. And so it's just been a very delicate balancing act, and risk markets have really suffered. Let me show you this. You mentioned that 30-year auction overnight. This is the U.S. yield curve in purple versus the China sovereign yield curve in cyan down here. This goes from the very short term to the longer term. China is actually looking like almost a normal yield curve, which slopes up. Usually it's going to slope up more. And then in the United States, of course, we've been with this inverted market for about a year and a half now. Let's take a look at the Chinese stocks, and we also have foreign currency. This is actually a 10-year yield, so I'm going to go to Chinese stocks here. We can see, and this is currencies. Let's see if we can, there we go. And this is not what I'm looking for here, but we do see some of these Chinese-affected stocks in the green today. Sorry about that, guys. Wi-Fi Interactive not participating here. But we finally do have our Chinese stock screen. Here's the heat map showing Chinese stocks under a bit of weather. I want to show you something interesting. The U.S. market has really come alive over the last month, since the beginning of November. And you can really see that over that same time, it's been a really mixed market. You see Alibaba down 15%, Pinduoduo up 26%. You contrast this with what's happening, for instance, in the innovation market and in disruption. And you see, for instance, Coinbase up 61%. That's only over the last month. Roku up 24%. So conditions have been much more favorable for tech in the United States. Over in China, it's more of a, take your pick. It's a very much a bifurcated market over there. Overnight news doesn't seem to have much effects on the market here today. I think the focus has really been on Japan and what's going on with their big meeting, interest rate decision in a couple of weeks. But nevertheless, interesting to watch how all the central banks in the world have to navigate this very sticky situation with inflation coming down, but the desire not to overstimulate.
Indeed. A lot of people wondering just how much intervention the Chinese government is going to have to do to prop up the economy here. Appreciate you breaking that down for us. Our very own Jared Blakely. Of course, out today, job numbers hotter than expected, but are they tracking everybody? Research from the Federal Reserve Bank of Boston suggests that those numbers may be miscounting gig workers. In the gig economy, jobs are often temporary or short-term, and as a result, official government surveys may be undercounting the number of those who are working. And with more than 57 million people participating in the industry, many Americans don't have the traditional social safety nets that official employees have. Well, for more on the importance of filling the benefits gap, I'm joined by Michael Bernick, former California Labor Department Director. Thank you for joining us this morning. So as we look at perhaps how much gig workers could be undercounted in the economy, let's talk about some of the key themes that are still keeping gig workers in the gig economy, because for some it's by choice, but for some it's out of necessity.
Well, you're right, Rochelle. It's a very wide world in terms of the gig economy. Some are there by choice, prefer the flexibility. Some, a growing number, are augmenting their income. But there are a lot of them who are in there because they haven't been able to find more stable full-time jobs. So it's a very wide range of independent contractors, contingent workers, leased workers, a wide variety of workers.
And Michael, in your op-ed with Newsweek, I want to talk about what you call the dark side of the gig economy. Some of these things that don't get talked about because people are not, full-time, 40-hour-a-week employees. Talk about that and some of the stopgaps, perhaps, that could perhaps at least support some of these workers.
Rochelle, I've been in the job training world now for almost 50 years. So, I've seen this has been a trend over since the late 70s. And it is the case that the darker side, positive side, is the flexibility, the ability to augment income, the ability of small businesses in particular to take on people. But the darker side, people struggling to make even minimum wage as independent contractors, and of course, the lack of health care and other basic benefits, especially unemployment insurance. If you're a gig economy worker in you're not eligible in nearly all cases to obtain unemployment insurance.
And something that people don't usually think about is the role they play in the growth of small businesses, because not everyone can afford to pay a traditional worker. But you also say that that also is some of the reasons why we're having these problems with not having the health insurance. But talk about the support that they've been for small businesses.
Well, it has been a plus for small businesses. You talk to small businesses in our state, California, they don't have the resources to hire someone full-time or even bring someone on payroll part-time. They are able to bring them on as 1099 or independent contractor workers. So it gives greater flexibility, especially when profit margins are far more limited. So there is a positive side in terms of businesses and for workers, but there is this darker side, and that's what we need to address.
So then, as we're heading into 2024, obviously an election year, you have a lot of good ideas here, but how to pay for them? Should that fall on these small companies? Who should really bear the brunt of having to pay this when you're already seeing wages have been creeping up and we're still tackling high inflation at the moment?
Well, as you said in your report on the job numbers this morning, wages have gone up 4.4% year over, but the wage gains are slowing for all workers. And including for gig economy workers. In terms of who pays for it, I think like so many approaches, it needs to be rooted in the private sector. And the positive thing, Rochelle, is there are a number of private sector firms that are arising, market-based firms, to address some of these benefit issues. Some of them are nonprofit. Most of all, of course, most well known is the Black Car Fund, but a number of for-profit firms looking to provide for gig economy workers, disability insurance, workers' comp, even forms of healthcare. That's very positive. I think we need to look at other classifications of workers. So long, we've had these two classifications, independent contractors and employees. We need more. The economy has become far more complex. We need additional classifications. And of course, I think we need to look at some form of healthcare coverages for people who aren't covered by private firms.
And Michael, just quickly, is there a chance that that's going to then prolong inflation as some of these companies do have to pay more?
Well, that's a question how much wages are driving inflation. I would argue, Rochelle, our inflation rate is being driven by other factors, including government spending, and not really so much driven by this wage growth. I think we can absorb a lot more improvement, strengthening of worker wages, especially at the bottom levels, without driving inflation. The inflation causes, I would argue, are elsewhere.
And we certainly have already seen that union push ticking some of these labor costs up as well. But a lot of this is about future-proofing the economy that we're currently in. Appreciate you taking the time to join us. Michael Bernick, former California Labor Department Director. Thank you so much. All right, coming up, wrapping up a rather lackluster year for IPOs, with some big debuts slipping below their initial gains. But could 2024 be different? Barclays Global Head of Tech Investment Banking weighs in next with an outlook for the year ahead. That's next on Yahoo Finance.
The IPO market failing to gain much momentum in the second half of the year following a group of lackluster IPOs. What does the outlook look like for 2024? For that and more, I want to bring in Kristen Roth de Clark, Global Head of Barclays Tech Investment Banking. Kristen, it's great to have you here.
Thank you. Great to be here.
So let's talk about some of the buzz here at Barclays Global Tech Conference. In terms of the sentiment, what you're hearing from business leaders, what you're hearing from investors, how would you categorize it?
Look, I think there's a lot of optimism. I think we're starting to see investors excited about 2024. It's a great time of year to have the conference because people are really looking forward to next year. We have 1,500 attendees this year. We have the biggest private track and the most impressive private track that we've ever had. And so the main focus is really on a couple themes. Both security and also on AI and applications of AI across a lot of different verticals. And then as you think about, what investors are looking at for next year, a lot of it is on what companies could come public. And with the backlog that we have of IPOs, there are some really impressive businesses that could come out.
Do you think we're going to see much activity next year?
I do. We had 5 tech IPOs this year. We had 2 tech IPOs last year. A typical year, we see 35 to 40 technology IPOs. So there's a huge backlog, and I think the companies that are going to come out are going to be much larger scale. They are going to be much closer to profitability, if not profitable. And so it's easier for investors to kind of lean into some of the businesses that will come out first part of the year.
When it comes to the catalyst in terms of what is going to make business leaders, these companies feel a bit more comfortable entering the public markets, what do you think that's going to be?
Well, so some of the things we're seeing right now is stability in the market, which gives investors more confidence. So things like a broadening of the, kind of what's working in tech. It's not just the Magnificent Seven. You're seeing, some of the more mid-cap names working. We saw the Russell 2000 up 12%, for example, in November. So that's obviously helpful. We have the VIX below 15 for a period of time, so there's some stability there. And then you've got, the companies that have waited this long to go public. As you start to see some stability, they'll have more confidence to enter the market, have an M&A currency. The other dynamic that we have is private equity firms have been haven't been able to return capital to their LPs as much over the last couple of years, given the slowdown in the M&A environment and kind of the lack of the IPO market. So I think there's a little bit of a catalyst for them to start to return capital to their LPs and exit in one way or the other, either through sales or through taking the companies public.
Kristen, you mentioned there just a minute ago in terms of some of the companies that maybe will likely go public next year, either close to profitability or are profitable. When it comes to some of those biggest names, any of those that you are most excited about or you think will finally take that leap?
Look, it's hard to discuss specific names, but I will tell you there are thousands of technology companies that are private right now. There are about 250 that are really high quality that we're tracking over the next 3 years that could go public. I think some of them will get bought, obviously, and some may choose to continue to stay private, but there's a group of a significant group of high quality companies, a lot of them in the software space, some internet, some semiconductors and hardware, services, payments, but a lot that are in the software space.
When it comes to AI, the hype, obviously one of the buzzwords here at the conference, is that going to carry that momentum, you think, and as much excitement? Is that going to carry into 2024?
I think it'll carry into 2024 and beyond. It is a massive kind of, movement that's happening in technology that is something that we haven't seen probably since the internet. And I think the most interesting thing is that it applies to a lot of different businesses within tech, and everything from improving efficiency for companies, not just in tech, but across all sectors, and also accelerating the pace of innovation. We're seeing that, for example, in the healthcare world, right, which is with the application of AI.
There's also a lot of focus or a lot of worry, maybe concern, just about the volatility that we could see in the market surrounding the election next year. In terms of then what that means for deal-making activity, what it means for the IPO pipeline, do you see that affecting it at all?
Well, I think that the IPO window next year will kind of be shorter, certainly because of the election. We could see things slow down heading into late September, early October. But I don't know that that's necessarily going to impact the number of companies that get public next year. There will just be more concentrated in the window earlier in the year. We've looked at election cycles historically, and you typically don't see a slowdown in number of companies that get public. It's just more per month during the windows that the market's open.
The biggest risks, the biggest challenges that you're hearing from business leaders in terms of how they're navigating that, what is potentially out in front of them in 2024, what do you think that is?
The biggest question the biggest issue we probably deal with right now with corporates in the boardroom is like thinking about how do we keep from being disrupted, right? And a lot of this is around AI. The one thing that I think AI is driving is accelerating innovation, and which is allowing some startups to try to catch up to some of the mid-cap, larger cap companies. And so I think, if anything, it's a paranoia of what could happen if we're not on our game as it relates to the advancements being made in AI.
Chris, another driving factor, one of the bigger concerns maybe has been around valuations, the pressure that we saw on valuations, especially over the last several months at this point. Are we starting to see a bounce back in that at all?
We are. Let me give you a software, for example. If you look at the top 10 software companies are trading at an average of 15 times forward revenue. And then, which is great, right? Double-digit revenue multiples is for businesses growing 20% plus. And then you take a look at overall just tech valuations. Tech valuations, the peak multiple of EV to revenue to growth was 1 times. The lowest point we saw was 0.2 times. We're back up to 0.4 times, which is more in line with historical norms.
Kristen Roth-DeClark, great to get some time with you here today. Barclays Global Head of Tech Investment Banking. Thanks so much.
Thank you.
And thanks to our very own Shauna Smith for that report. Right, well, now to the need for speed. It starts at $171,000 with a 190 mile per hour top track speed. And poor old Yahoo Finance's Pras Subramanian has been taking it for a spin. So Pras, is the Targa 4 GTS the best version of the Porsche 911?
Well, that is a good question, Rochelle. But let me start off by saying that obviously the Porsche 911 is an iconic sports car. And not just for Porsche, but just for the entire industry in terms of it is an iconic car nonetheless across the whole sort of the landscape, right? But the new 911 is supposed to come out any moment now, and that might be a hybrid is what people are expecting it to be. So right now, the 911 is still a non-hybrid car, and I think that people are asking, well, should buyers jump in on something like this before it goes hybrid, before it changes its sort of formula? And I think that the 911 Targa 4 GTS might be the best version of the current 911 out right now. So, we just showed, the outside of the car is the classic 911 silhouette, that teardrop sort of fly line shape there that everyone recognizes. But it also has, in this case, a hardtop convertible. I think that glass part opens up and it hides the hardtop, so you can have the best of both worlds, a coupe driving experience as well as a convertible. Inside, we just showed the inside, of course, just still sumptuous interior. Porsche still does a great job. And also, in this case, a 6-speed manual transmission, very rare these days, of course. And then, of course, that leads into the driving experience, which I had for a few days, and that was an incredible, I thought, experience for me. Of course, the manual transmission being one of the things that's going away these days, but for people who like it, it's an engaging experience. In Porsche's case, it's a nice short throw, great clutch action. Just the car just drives on a line with the fact that it has the rear engine set up, great handling. You can't go wrong with it, of course, and many people, besides me, feel the same way.
But Pras, the price. Do you think it justifies the price for this hybrid version?
Oh, for the upcoming hybrid version? I'm not sure how much that'll cost. Right now, this one, like you mentioned, $171,000. It does not come cheap. The 911 used to be a relatively cheap sports car that people could get who weren't the super rich, and right now it's inching into that supercar territory. I would say that maybe you wait a couple years to get this car when it's in the used market. Maybe you get an older 911 now, but if you can afford it, this is one of the best cars for the money, just hands down in terms of a pure driving experience.
I love all the classic details that are still in the design. It does make it special. I like a good classic car, so I love that.
Yeah.
Always great to have you on Take, our very own Pras Subramanian, living the tough life.
Thanks, Rochelle.
All right, taking a look at gene editing making its jump into the mainstream. A new drug developed by Vertex Pharmaceuticals and CRISPR Therapeutics has secured FDA approval for treatment of people with severe forms of sickle cell disease. It uses CRISPR, a tool that allows for the editing of genomes. Using the technology, doctors and researchers can alter DNA sequences by either turning off or replacing genes. It can be used to correct and treat genetic disorders like sickle cell disease. Now, this technology marks the first CRISPR-based gene editing therapy to get approval in the US. The president of Vertex Technology called the approval momentous in a statement. All right, well, that does it for now. I'm Rochelle Akufo. Thanks for watching and have a wonderful weekend.